What's happening is that why the private credit market is going up, and the way the sequence of events in India is that till 2018, the private credit market was booming, right? And the two segments that were booming were doing in real estate financing because real estate developers were willing to offer 18, 19, 20% to take money for the real estate development, right? And that was all going into the private credit space. Things like the pandemic, etc., created for India, right, has just given such a huge fillip to fintechs and technology that has suddenly become a lot more interesting than it was prior to that.
The one thing which I loved in this conversation is this phrase BIPS. BIPS or BIPS, it's basically the short form for basis points. A financial services guy will look at where he can get a few more BIPS out of the transaction or a few more BIPS from a customer or provide a service and charge BIPS for it. And these BIPS really add up. You might feel like 0.01% is nothing, but when you're talking of large volumes, this is where the money is to be made. In this episode of the Founder Thesis podcast, I'm speaking to Tashwinder Singh. He's the MD of the publicly listed fintech Niyogin. Tashwinder is an amazing guest. He spent 2 decades in the financial services industry, worked in banks, investment banks, private credit, and I got to learn so much about the Indian fintech ecosystem from him. I'm your host Akshay Dutt, and this is the Founder Thesis Tashwinder, welcome to the Founder Thesis podcast. You are like a financial services veteran. You've been in this industry for donkey's years, starting with Citibank. Uh,
Correct.
I want to kind of understand through your Citibank stint, what are the different parts of a bank? What all parts did you work in? Just help me break down what a bank looks like.
Yeah. So I think fundamentally, at a very basic level, right, there are two big streams of businesses that banks run, right, and one would call it the corporate investment bank or the entity that is focusing on corporates, serving the needs of the corporates, and then there is the consumer bank, which is serving the needs of individual consumers like you and me. So at a very macro level, I would say you could break a bank into these two buckets because the product set required by these two segments are very different, right? And Citibank also thought of life exactly the same way. And there were two entities. One was the Global Corporate and Investment Bank, and then there was the Global Consumer Bank. So two real business verticals going all the way to the headquarters in New York as separate verticals. That's how Citibank was structured in the old days. I used to be part of the Corporate Investment Bank, and after finishing my MBA at the Faculty of Management Studies in New Delhi, I joined Citibank through the campus recruitment process at the Corporate Investment Bank. Now, in any institution, right, and banks are no different, there will always be functional areas, right? For example, there'll be front end sales, there'll be product management, there will be operations, there will be service, right? And then there will be other support functions like finance, audit, etc. So when I joined the bank, which was in 1994, I think the bank had a very clear objective of trying to make sure that management trainees, as we were called, we are able to understand all aspects of banking, not just go into one department and stick with that. Spend the first 4 5 years really moving around different parts of the bank to become truly a well-rounded banker. Because the only way you can become a well-rounded banker is if you've actually seen different parts of the institution, both functionally and business-wise. And that training is, I think, invaluable. I still think that was potentially and possibly the best training anybody could have got in the banking industry. So I spent my initial few years in operations, right? Then I moved into service, then moved into product management, and finally into business management, running businesses for the bank. Towards my and like I said, this is all in the corporate investment bank. The consumer bank also has a similar structure where you would have operations, you will have product management, and then you have different products, whether it is credit cards or mortgages or just branch banking, for example, right? So that's really how banks are fundamentally organized. And
What is what does product management do? My understanding of product management comes from like the tech startups, where a product manager is somebody who's uh, thinking in terms of what will get the user to perform a click or to
right,
buy something, or so on, like
Right.
optimizing it for the user.
Right.
What does a product manager in a bank do?
So product manager again in a bank, again, let me break it up into both the buckets and tell you what product management function is on both the sides. One on the corporate investment bank is focusing on the various products corporates use. For example, corporates may want trade finance. They may want to issue guarantees. They may want to use cash management. They may require investment banking services, right? Things like that. So everything is a product. Someone needs to own that product. Someone needs to be a CEO of that product, for want of a better word, right? Product managers, in my view, were CEOs of individual products, and they looked at how do we make sure that the customers are using this product and the product is the best in class product, both in terms of service delivery, in terms of cost of delivery, in terms of profitability that product can deliver. On the consumer banking side, the same logic would apply. For example, if you look at a credit card, a credit card is a consumer product, right? Now you'll hear about lots of banks launching newer credit cards with new functionalities, with new offers that are coming on the credit cards. Could be cashback offers, could be hotel stays, etc. So that is a product management role, right? You are creating the project, the product, underlying product. You are responsible for making the product interesting and attractive for the consumer that you are targeting, right? So no different from what you would do in a Unilever where you are thinking about selling soap. You need to make sure the soap is priced at the right point in time. It is selling through the right distribution channels. There is enough marketing happening, enough advertising happening. You are basically the CEO of that product, right? So it was similar to that.
And what are some of the products within corporate banking? Like that's where you spend most of your time.
Yeah,
So
yeah. So I used to be a product manager for the cash management products, right? In cash management, what used to happen is that and I'm like I said, I was with the corporate investment bank. The corporate investment bank companies that we would provide services to were selling their goods in various parts of the country. And in the old days, when you did not have things like UPI and NEFT, etc., they were selling in different parts of the country and they were collecting checks in different parts of the country. Somebody had to collect all those checks and bring all the money into a centralized account. So the entire ecosystem of figuring out, if you have a check in a place like Agra, how do you move that check? Because that check has to be locally cleared in Agra, right? Because it's if it, in the old days we didn't have payable at par. Payable at par today means that the check can be cleared anywhere. In the old days, each check was for a certain destination, right? It had to be cleared in the local clearing system of that network. So we had, and foreign banks only had very few branches. We did not have a branch in every state or every city, like unlike a State Bank of India. So the foreign banks would then tie up with local PSU banks to act as their correspondent banks to clear the checks. So, for example, we had Corporation Bank as one of our correspondent bank, where we would submit all the checks which were picked up by our agents in Agra for our customers. We will deposit them with Corporation Bank. Corporation Bank would put that through clearing and then would transfer the money to us. And for providing this entire service, we could charge the customer a certain fee because we were making them funds available to them in a centralized place so they could use those funds more efficiently. And otherwise, what would happen is that money would be locked in some bank account in Agra. They've got some deficit in Bombay or deficit in Delhi, and it would create inefficiencies in the system. So the cash management proposition was created fundamentally to take advantage of the inefficiencies in the system and provide a more efficient solution for moving money around. Today, of course, the world changed because the technology has come in and has made movement of money much easier, much faster, much cheaper for companies, right? But the other point that was linked with this is that you also needed to see that when a company is selling in 10,000 locations and they're going to get money from each of these locations, there is this huge need for MIS and reconciliation. How do you make sure which money has come from where? They need to map up that money from which customer has paid us. So banks were helping with even helping companies reconcile the fund flow that was coming to them from various locations. So the cash management product proposition was creating that whole infrastructure, creating the technology to be able to make sure the money moves quickly into a centralized office, having all the bank agreements with the correspondent banks, getting all the MIS, creating the digital infrastructure for the MIS to be available to customers on a digital basis, and provide solution and then price this entire service appropriately so it made sense for the customer. That was a product manager's role. Now, different people would get involved in delivering the product. Operations team would get involved in making sure that the reconciliation is done, etc. There would be front end teams out there that would be arranging agents to go pick up the checks from various people. I'm talking about cash management specifically, right? So cash management was not physical cash management; it was actually check management in some sense. But the
hmm.
product used to be called cash management. That's just how it was, the nomenclature.
Fascinating. It sounds like you were almost building a fintech.
It was actually a fintech before the fintech, and banks like Citibank were at the cutting edge of technology. If you think about it, the first ATM was brought in by Citibank. Citiphone banking, which is phone banking, was brought in by Citibank. So at one stage during our time in the bank, I think the bank was at the cutting edge of tech. Even cash management, Citibank was the first bank that really took advantage of this quote unquote inefficiency in the system to try and create a more efficient method for corporates to be able to get access to their funds faster, and using technology, infrastructure, relationship with correspondent banks, etc. You put all of it together, right? It's not only technology, right? It's a business you're building. Technology is enabling you to some extent.
Why is Citibank not a major player in India today? Is it regulatory reasons, or that the
I think
Indian
Citibank,
banks were able to outcompete? Or
yeah, I think Citibank. Of course, I've been out of the system for a long time now. Right? I left Citibank in 2012, so everything I give you is a little dated, and more from what I hear from my colleagues. Right. Firstly, Citibank is quite a significant player in the corporate investment bank space. What has happened is that, and what
what is the
Citibank.
investment bank space? First, why don't you just break that down a bit
So I
also?
think let's talk about corporate investment bank is basically anything and everything to do with companies. If you're solving the needs of a company, whether it is for a company to raise capital, to take debt, or to help them manage their trade finance, right? Help them with their trade, right? They're selling goods overseas. You need to have a letter of credit to be issued. You need a guarantee to be issued. All of that comes under the ambit of corporate investment bank. Investment banking is if some of these companies want to go public, they want to raise money, right? They want to go acquire other companies. All that comes under the purview of investment banking specifically. But these are corporate activities. Companies do this, right? Companies buy other companies. Companies go raise private equity. Companies are going and selling goods from a trade standpoint, etc. All of that, right? So as a banker, if you're providing services to them, you're part of the corporate investment bank, as I mentioned earlier. Citibank sold off their consumer banking business to Axis Bank. So, the point is strategically the bank decided that they wanted to exit the consumer banking business in most countries. I think today Citibank only has consumer banking business in about three or four countries. Obviously in the US, London, Singapore, and maybe one or two other hubs, maybe Hong Kong. Most other countries, Citibank has exited the consumer banking business. Good or bad, I don't think there's any point in discussing if the decision was right or not, because the decision's taken, it's done. I think we all need to move on from there. So in the consumer banking space, Citibank is not a player today. There is no Citibank business that exists in the consumer banking space because they vacated that space, and that business is now run by Axis Bank. In the corporate investment bank, the bank continues to be a material player. But what happens when the corporate investment bank is any bank in India was running both the consumer and the corporate businesses, because they would get a significant set of rupee deposits from the consumers. People like you and I keeping our savings with banks would lead to the deposits. A rupee deposit base would get created, right? Now, when you don't have a significant rupee deposit base, then the proposition that you are selling to your customers are usually foreign currencies propositions. Citibank can help access foreign currency markets. So if you are a company that wants to raise foreign currency bond because it is cheaply available, because even on a swap basis it makes more sense to take a dollar loan, then Citibank becomes a very good player to go with. But if you want to take a rupee loan, when you compare yourself to an Indian player where Indian banks have significant rupee liquidity, they will be more efficient. So I think what's happening in the banking space is that there are different strengths and niche that are getting evolved, and different banks are having the competency to play in those different niches, right? So anything to do with rupee and rupee financing, I think the Indian banks certainly have an edge. Anything to do with foreign currency financing, you will find that the foreign banks may have an edge because their ability to access foreign currencies because of their global networks is significantly better.
Okay, okay, interesting.
Yeah.
Got it. Okay, so what made you want to move on? Like 2012, you moved on. What caused that change, and where did
Yeah,
you
so
go
I
next?
had spent 18 years I had spent in banking, and I never worked anywhere else. Right from after my MBA, I joined Citibank, and I had a long run of 18 years. Pretty much did everything. Towards the end of my career with Citibank, I had already been on the management committee of Citibank India for many years, and I had to choose between two options in life. One option was to move overseas, and Citibank had offered me a job in Singapore in the private bank business in Singapore, and the other option was to do something which could be a little more interesting or something else in India, because India continued to present this situation where the opportunity set has always been fantastic for India, right? And every few years we used to have this big joke that every few years, India's turn has come, and we used to miss the bus for whatever reason, political, non-political, whatever the case may be, right? But the potential has always been huge, and today again I say the same thing, that there's no better place to work. The action on the ground in India is palpable. I mean, I travel around the world and I see what's happening in different parts of the world. Not to put anybody down, but I think the energy and the palpability of that energy in India is unparalleled, right? I mean, you're based in Japan right now, so I was at the Singapore Fintech Festival few weeks ago, and I think 70% of the people presenting their propositions there were all Indian companies. So there was, I mean, 70 is just a rounded off number. I'm not giving you an exact number, but I'm just telling you that's the feeling I got, walking on the stalls and everything, right? So there seems to be a lot of activity. India's become the hub for fintech globally. I mean, the amount of
Right.
fintech startups that are coming out of India is just tremendous. We are all 1.4 billion people, right? And there is so much of catching up to do for these 1.4 billion, right? Whether it is getting them into financial inclusion or what have you, right? So at that point in time, I think the focus was, I did get the opportunity because one of my previous bosses had moved to a private equity fund, KKR, and they were looking to beef up the team in India. And to me, that seemed like a very interesting play. It also allowed me to round up my erstwhile experience of being in a bank to put it to a different use, to look at companies from a different lens, because I had never looked at companies from an equity standpoint. As a banker, you only look at it from a debt standpoint, right? You're providing credit to them. So it just sort of looked like the right decision at that point in time for me to sort of hone up my skills by working in a different aspect of looking at companies, and working with a top notch world class organization, right? KKR, in my view, is the original entity that started private equity in the world. So to work for an institution like that was not something that you get, an opportunity that you get many times. Had I moved to Singapore, I would have been with Citibank. It would have been, of course, newer market, but the institution was the same. So it was just one of those decisions I took, that it makes more sense to get wider experience, and then try and see, maybe I'll catch the growth curve of India, if we actually did catch the bus. And I think over the last 2012 onwards, I think India has caught the bus multiple times, right? I think we sort of grown quite materially. We've become relevant quite significantly in the world, right? And I think the next 5 7 years are super critical on how our economy develops, and the opportunity that things like the pandemic, etc., created for India, right, has just given such a huge fillip to fintechs and technology that has suddenly become a lot more interesting than it was prior to that.
Mm. And what were you doing at KKR? What was your role there?
So my KKR, I was initially, I was brought in primarily because my Citibank experience was working on the commercial bank, and I was dealing with the mid market companies, right? And I think the original focus was that I could provide access to the mid market promoters, and we could do proprietary deal sourcing by going and talking to them. So that was my original focus. KKR also was thinking of going beyond private equity. KKR had already thought about creating a credit fund. They had thought of creating a real estate fund. There was a special situations fund. So KKR had become a microcosm of what KKR in New York used to be, right? New York, they had multiple strategies. In India, they started with private equity, but they wanted to expand into multiple strategies. And therefore, I was brought in, largely looking on the credit side, along with a bunch of other people. So we had a small team, and these organizations are not large organizations, right? You'll have 10,000 people in a bank, in a KKR, you'll have 30 40 people. So there's a lot of
Mm.
heavy lifting everyone has to do, irrespective of designations, etc. So it was very interesting. It was, after having sat in the ivory towers in Citibank, it was about getting your hands dirty again. And there's a certain thrill to that, right? That you're back to the basics. It sort of brought a lot of energy into the whole ecosystem. So I was looking on the credit side. We were launching a local credit fund. I looked at creating the PPM for the first local credit fund that we launched. After that, we
What is
launched a set.
PPM?
PPM is the product manual that is created when you
Okay.
launch a fund. When I go to an investor, I have to give him a PPM saying, this is what we're going to do with your money if you give us your money.
Okay.
So it's basically
Okay. Okay.
a document, it's a product manual that you create before you can raise capital. So it was interesting. I think in 2012 to 2016, 2017, I think we did some really good cutting edge deals. We provided financing to a lot of Indian promoters who were mid market promoters, but who had situations that needed to be solved. Right. For example, someone had sold a private equity to a private equity, 51% of their company to private equity, wanted to buy it back. We would provide them some financing. Some companies were distressed, but they had assets underneath which needed time to get monetized. So we came in and termed out the entire capital structure, took out all the debt, gave them a new debt, which was a longer tenor debt, but giving them time to basically find a way to monetize whatever assets they might have in the company, and therefore saving the company. So I think some of the deals we did were very interesting deals. These helped companies survive, thrive. Obviously, we took our pound of flesh when we did that, because we were coming in in some cases in distress situations, in some cases in complicated situations, right? And those were good. The power of the KKR franchise then was that we could get into a conversation with the customer without necessarily thinking about what product to give to the customer. The difference between, if you were only a private equity fund, you would be a single trick pony. You have only one answer in your bag, and therefore you'll only give that one answer. When you have multiple answers in your bag, I can do debt, I can do equity, I can do special situations, I can provide other kinds of financing for this customer. Then what I'm doing with the customer is I'm trying to solve the problem, and I'm trying to find the most optimal solution for the customer because I have multiple solutions to offer. So that was, I think, the franchise that was being built in KKR, wherein we said that we could, rather than being focused on a product, we focus on the customer and the problem of the customer and find a way to solve the problem, because we have multiple products in our kitty, right? As against some of the other PE funds which only had an equity answer to the kitty. And sometimes equity is not the right answer because, the company is too distressed, or it would lead to significant dilution. Sometimes the right answer is a non-dilutive structure, right? Because the customer does have some security to offer. He could give you real estate or what have you, and you could provide that solution, right? And also, why it made more sense at that point in time, because India, the banks have been super regulated by the central regulator, right? RBI. And the banks can not do a few things. For example, the banks cannot give you a loan which is a zero coupon instrument, right? You can't take a zero coupon
What does
instrument
that
from
mean?
a bank. It's not allowed
What
by
does that
law.
mean? Zero coupon?
I mean, there's no interest to be paid. All interest is back ended. So I give you a loan
Okay.
today because your business is not throwing up any free cash. You don't have money to pay me interest, but you can pay me interest at the end of 2 years. So the flexibilities that you could do through a fund or through an NBFC could not be done through a bank. And that created opportunity as well for structuring of deals where you could come in, look at the genuine cash flows that the company could provide, and then term your structure in line with the cash flows the company was generating, as against trying to say that no, this is the only answer I have, take it or leave it, right? So that then
Right.
allowed us to be a lot more thoughtful in how a deal could get structured in line with what we thought the company could deliver, and then meet objectives, and obviously charge some fee for doing all the work, right? So it was very interesting,
Mm, mm.
extremely heavy on the
You
intellect,
said
if I
mid
could say.
market. How do you define mid market? What turnover?
So I think if you take out the top 500 corporates from the country, right, or you take the top 1,000 corporates, right, in City, our definition of mid market was companies from anywhere between $100 million of sales all the way to about $1 billion of sales. So a company that has $1 billion
Okay.
of sales would come under the mid market. Anything above $1 billion of sales, we said, was a large corporate, right, and
Enterprise,
and should
large corporate.
is
Okay.
a large enterprise, needs to be looked
Mm.
at very differently.
So this whole space of private credit has been blowing up. Like traditionally,
Yeah.
debt meant banks and
Right.
equity meant private players like private equity, VCs.
Right.
Which now I think more and more banks are kind of giving up that space of debt to private credit players. Why is that happening? Like, why
So
are banks
banks,
getting crowded out of this?
no. I think that's not correct. The banks are not giving up the space of debt. What's happening is, if you look at a company, right, and you look at the capital structure of the company, right, the highest risk is the equity, because the equity is basically equity risk, right? It's basically your money which has gone in to start the company or what have you, right? And the lowest risk is bank credit, because the bank is taking the security of all that is there. The bank is giving you money which is working capital money, etc., all of those kind of things. There is a sliver in between equity and debt, which could either have a look like equity but is not completely equity, may look like debt but it's not completely debt. That is the space where private credit is playing in. So I actually think of private credit as a mezzanine solution between equity and debt, because a private credit player will never be able to compete with a bank on financing for pure debt. Simple debt, you want to take a mortgage loan, right? Mortgage loan is available to you at 8.35, 8.5% in India. How can a private credit player ever compete with that. Banks do get deposits that they're getting at 4 5%, 6%, which is consumer deposits, people like you and I giving money. They're able to use that money and lend it out at 8 9 10%. We will never be, no private credit player will ever be able to compete with the bank in that space. What's happening is that people aren't giving up spaces, people are getting slotted into where they have their strengths. Banks have their strength in what we call senior lending, which is a senior lending stack on a capital structure, which is the least risky capital stack in a structure. Why? Because they have the best security on the
Mm.
company's performance, right? And then the equity guys have no security because equity risk is full equity risk, right? If the company goes under, the senior guys are the first guys that will get paid. So if you liquidate a company because the company's cash flows didn't come in, and then you went through the whole bankruptcy proceedings, whatever is left, the first people to get paid are going to be, apart from the government and labor and all of that, those things I'm keeping out of it. I'm talking about financial creditors. The first people who will get paid are going to be the banks, right? Then they're going to be the mezzanine guys, and then it's going to be the equity guys. So the private credit is operating in the mezzanine, and by the way, the return expectations also changes accordingly because risk and return have to play a game out here, right? So when the senior credit in India, and I'm talking about rupee loans now, rupee loans are anywhere between 9 to 11%, 9 to 12%. That is what is the senior credit category. You come to the mezzanine category is between 12 to 16, 12 to 18%. And the private equity guys are trying to solve for 20 to 25% return. So that's really how the cookie crumbles, right? So there's obviously a lot of noise. The market doesn't understand this, but one should distinguish on what sliver you're playing the game in, and you're not getting crowded out, right? A bank trying to go into the mezzanine space will get crowded out because the banks don't have the understanding of the mezzanine space to be able to provide credit, and they don't even have the mandate. In all fairness, the central bank does not want
They
to
don't
lend
have the
money.
risk appetite.
They don't have the risk appetite. They don't even, in some countries, I mean, forget India, in some countries the central banks don't even allow them to have the mandate to do this. So
Right.
that varies. So what's happening is that why the private credit market is going up, which is I think the right question to ask, that there's been a significant, and the way the sequence of events in India is that till 2018 the private credit market was booming, right? And the two segments that were booming were what we were doing, for example, and what a lot of people were doing in real estate financing, because real estate developers were willing to offer 18, 19, 20% to take money for the real estate development, right? And that was all going into the private credit space. Construction finance in the real estate space, which means I've already got the project already approved, but I need money to construct, that would be in the banking space, because that you could borrow money at 11, 12%, right? So private credit had no interest in giving money at that rate. So construction finance would go into that. But if a company wanted to buy land, or once you get a project, it takes you about a year, year and a half to get all the approvals to start construction. How do you fund yourself for that year and a half? That is where the more expensive debt comes into play. So private credit was always playing in that space. And then 2018 is when we had the IL&FS crisis. The IL&FS crisis, what I think was the GSC moment for India, right? The global financial crisis moment for India, right? There's no Lehman in India, but that was the Lehman moment for India in some sense, right? That seized up all the banks, right? And therefore, a lot of the private credit players who were getting back leverage from banks, etc., right, were running it like NBFCs. Those people all seized up, and because companies who was looking to take credit could not get incremental credit, so companies started falling and they started defaulting. When they started defaulting, what they defaulted first on was the private credit loans that they had. So private credits actually saw through a significant loss that came in, right? And that took about 3 4 years, and then we were immediately followed by the pandemic, right? If you think about it, 2018 was then immediately followed in 2020 by the pandemic. So that problem continued all the way till 22 onwards. The private credit market has come back with a big, big, big boom in the Indian markets. Today, if you really start talking about, every large player is talking about getting back into India in the private credit space. So businesses go through cycles, right? I think we had almost a decade of extremely good run in the private credit space from 2010 to 2018, 2009 to 2018, and then 18 to 22 was a complete bad run because of various environmental conditions, etc. Promoters defaulting because the environment didn't allow them to get refinancings or get monetizations done, etc. And then 2022 onwards, we have seen this resurgence of the private credit market. So these businesses move in cycles. We had some event risks that came in 2018, that hurt the private credit markets. If you did not have those event risks, I think those private credit markets would have continued to boom throughout that period, right? So the 2018 crisis followed by the pandemic was just two real big events that hit the markets in a very big way, right? I mean, it's obviously we have the luxury of sitting out here and looking back, at the history of it. And when you were in the thick of things, right, obviously things were not, as good as we'd like them to be. But they were interesting. They were good learnings.
What was IL&FS? Was it into private credit? Like, why did IL&FS impact the private credit market?
So ILFS had a significant borrowing from every bank in the country. ILFS had more than 1
Right.
lakh crores of borrowing, right? And
And
they had
whom were they
taken the
lending
borrow.
to?
Well, they were lending to infrastructure companies. ILFS was infrastructure leasing and finance company, right? ILFS was infrastructure
And
leasing and finance
mezzanine?
company. Yeah, they were doing all kinds of deals. They were doing mezzanine deals. They were doing senior secured deals. They were doing everything. And the problem
Okay.
was that there were questions, there were integrity issues that came up, right? That because they were rated, they were not a government entity, but they used to get a AAA paper rating. How were they getting a AAA paper rating was questioned, right? And they defaulted because they had taken so much of money. And infrastructure companies, when they started, some infrastructure projects got delayed, etc. There were some delays that happened, and there were defaults. Then the whole mystery unraveled because they could not get refinancing done because their ratings dropped materially. And one fine day, basically people questioned whether there was siphoning off of money, etc. I mean, I don't want to talk about that because this was under the realm of the regulator, and there was Mr. Uday Kotak was involved in trying to see how to solve that problem and all of that. And so ILFS was managed much better than how Lehman was managed in the US. I must say this. I think the Indian regulator probably did a much better job in trying to figure how to solve this issue in a organized manner. But the market did seize up because people lost faith in credit ratings. People, when I say banks, lost faith in credit ratings. And banks stopped lending because they were not sure who to lend to, not lend to. Banks started pulling back on the debt that they've given out to companies. Companies can't just pay back debt, right? Because once you're in the middle of a project, you can't just repay the loan overnight. And therefore it created what is called a credit squeeze, or what happened with the Lehman crisis also, that basically credit just disappeared from the market. So, and that creates a problem because certain
Hmm.
companies are working with the assumption that they will keep getting some amount of credit, right? And if the credit does not come in, then business starts stalling, then they default on their next repayments, and therefore it becomes a continuous cycle where you have multiple problems coming in.
So banks also indirectly participate in private credit by lending to
That's
the
right.
private credit players.
That's right. That's right. They
Okay.
do. They do. So
And
private credit was being run in two ways, right? One way was that private credit, you could create a private credit fund, in which case banks were not involved because you were just a fund. You were a conglomerate of private money that had been pooled together. But there were also people who had built NBFCs, non-bank finance companies, and non-bank finance companies were being back levered with bank money, right? And that money was therefore being put into, well, transparently. It was not that it was not it was all completely transparently done, but banks were part, but it was a small portion. I don't think that was a significant portion of the bank balance sheet, right? It was a small portion. So I wouldn't really worry about the banks having put money in that. But I think what happens is when a big crisis, 1 lakh crore is a big amount of money, as far as ILFS is concerned. Obviously, everybody got concerned. And the first thing when you get concerned is to say, okay, just stop what you're doing. Let's first assess where are we, right? Let's not do more. Let's just pause, right? And that's a natural human reaction. It's not unique to India or to ILFS or to Lehman or to what have you, right? It was a natural reaction which you would find everywhere, which is exactly what happened with the Lehman crisis. Also, all the banks in the US also said, pause. Let us assess where we are, right? Don't do more right now. Let's just figure out where we are. And in that pause, depending on how long that pause is, a lot of people would fall off the cliff.
hmm. So this is what led you to kind of move out of the private credit space and get
Yeah,
into
so I
fintech.
think I think two things happened, right? I think KKR also decided they wanted to sell the private credit business, and they sold it to an entity called Incred, right? And so a bunch of us in 2000, I left in 2019. I think KKR finally sold the business in 2020 to Incred. And I think at that point in time, I was still pretty optimistic about the private credit markets coming back because fundamentally we had seen the golden era of the private credit markets, right? From 2009, 10 to 2018, we had seen a fantastic run on the private credit markets. And then you do face headwinds once in a while, but the headwinds, come and go, right? If you have the ability to stand tall in those headwinds, then you can continue, doing well. So I think the thought process I had that point in time was that, having worked in the financial services for so many years, 18 years with Citi, almost 7 years with KKR, right? That was almost 25 years of experience. I had two ideas. One idea was that maybe we should create another private credit fund, which we should do, three, four of us get together and create our own private credit fund, because we still felt the market was interesting. And we thought that uh, distressing times create a lot of opportunity, right? It's just that that distressing time got immediately followed by the pandemic. So creating a fund when you were in the middle of a pandemic was out of the question. No one could come and do diligence with you. No one would come talk to you. So that was the thought process. If the pandemic was not there, then maybe we would have already created a second private credit fund, and we would have been in that space, right? Hopefully riding the wave now as the wave has come back, right? But that didn't happen because we were immediately followed by the IL&FS crisis with the pandemic, and therefore it was impossible to do that. At that point in time, the pandemic created incremental opportunities, right? When we figured out that people were not able to access their banks, people were not able to, especially in rural India, people were not able to, get access to very basic banking services. I looked at my erstwhile experience when I was running the commercial bank in City. When I used to run with small businesses, I was basically providing financing to businesses that could be as small as 2 crores, 5 crores, 10 crores, all the way up to $250 million businesses. I had the mandate to look at this entire franchise, and I said if I look at the lower end of the spectrum, there are a lot of these retail stores that are just not able to survive. Retail stores are not even open. How would these companies survive? Right? You could not go to a retail store for almost a 6, 8, 9 month period. Everything was shut in the country, right? As you probably know, during the pandemic, right? But that created an opportunity for us, saying that there is a need for us to get technology to solve this problem, right? And that's when Niyogin sort of came into my purview, because Niyogin had already been set up in 2018 by two people, Amit Rajpal and Gaurav Patankar. I'd known both of them. Gaurav I had known for more than 25 years, because Gaurav used to be an ex-City banker, and Amit still is a senior partner with Marshall Wace, which is a hedge fund, and KKR owns 60%, I think approximately 60% of Marshall Wace. So there was some connect, but Gaurav, Amit, and I got together, and their point to me was that since you are thinking of doing something new, why don't you come and run Niyogin? We had raised some capital. They had raised some capital at that point in time, and the strategy was just evolving. One thought process was that why don't we give credit to the small MSMEs once the pandemic is sorted? Because during the pandemic it was impossible to give, or what else could we do? And that's when I think we got down to the drawing board to think about what technology solutions could be deployed, given that the extreme lacuna in a lot of people getting access to formal financial services was became I mean, it became so evident during the pandemic. We said there is a ways and means, we have to find a way to solve the solution. So we acquired a few companies. We acquired a company based out of Bhubaneswar.
But
uh,
before
Sorry.
like I want to little bit more on
Please,
the
please,
origin
please.
story of Niyogin. Uh, so you decided you want to do something in MSME lending.
Yes.
Why did you decide to do it by acquiring an existing business? Like Neogin already existed as a business with a long, like a 2 decade plus history, which you decided to use that as a
No, no, no.
vehicle
So
to.
Niyogin did not. No, that's let me correct you. Niyogin did not exist with a
Okay.
2 decade history. There was an existing
Okay.
NBFC which was existing with a 2 decade history. Niyogin got formed in 2018, and Niyogin went and acquired that company, which was the 2 decade old company.
Okay. Okay.
So
Okay. And
Niyogin was
that
a
was
new
a
entity.
publicly listed company
That was
which
a public
got
listed
acquired.
company, and that company had a non-bank finance company license. And therefore, when
Hmm.
you want to do lending in India, right, you need to have an NBFC license, non-bank finance company license. Now you have two
Hmm.
options. One option is you go apply to RBI for a new license. Second option is you go acquire an existing license, which again gets validated and ratified by RBI. So you're not doing anything behind anyone's back, right? So
Yeah, but it's
rather than
faster.
going and applying for a new license, it was in the wisdom at that point in time, it was felt that acquiring and getting RBI to bless the acquisition is a faster way to get the business off the ground. And so the acquisition was largely done to acquire the non-bank finance company license.
And this was like a kind of a reverse merger where you are now a publicly listed company, or you bought out the public and now it's a private limited company?
No, no, no. It's not a private limited. It's a public limited company. Basically, the
Okay.
founders were bought out. The founders of the previous company were bought out. Public was still an investor in that company, and
Okay.
new capital was infused in that company, right?
Okay.
And therefore new shareholders came in as new capital got infused, and that's how the company got formed.
And
And
it was
and
renamed as Niyogin.
and it was renamed as Niyogin.
Okay.
M3 Global was renamed as Niyogin, and therefore the journey for Niyogin really started in 2018, end 2017, early 2018. Now
What was it
2018.
doing when you
So
acquired? Like, what was the
yeah,
scale
so
at?
so
Like,
I joined. I came in. I really took over the reins of the company in 2020. But
hmm,
between 18 and 20, the company, obviously since they bought the NBFC license, started lending to the MSMEs, right? So it was only a lending shop in the first 2 years of its existence. Of course, the way the lending was done was quite unique, and I think the thought process at that point in time was that if you want to see what happens in a lending business, right, Akshay, you have three elements. You have client origination, you have underwriting, and you have collections. You need to originate the right kind of clients. You need to have the right methods to assess whether they deserve to get the money or not. And after you've given them the money, you need to make sure you collect your money back, right? These are the three broad aspects the way I think about lending, right? I think what they did was they created a unique mechanism for acquiring customers. Because if you really go back and start analyzing all the lending institutions, you'll find that they spend a significant amount of their total cost in the whole chain on client acquisition. Because the client has the ability to go to 10 lenders, right? Why should the client come to you? So you need to be out there telling the client why you are a better person to lend, to take money from, etc. Right? Now, different people have done either you can advertise or you can create call centers, right? Or you can create other methods by which customers come to you. I think Neogin's original thought process was that instead of going to the MSME directly, why don't we go to the person who is the trusted advisor of an MSME, which is typically his CPA or CA, right? A chartered accountant of an MSME is the person, because here the MSME definition is a person who has a sale of maybe 10, 15, 20 lakhs to maybe a crore. So this is like a retail store, a small company, right? A tier three supplier to a auto component, etc. Those kind of people, right? They are significantly dependent on their chartered accountant because all their filings, regulatory filings are done by the CA. When they need a little bit of loan, 5, 10, 15, 20 lakh rupee loan, they go to the CA and they tell him that, listen, I need this small financing because I have a urgent need, etc. So the CA is usually plugged in. So what we did first in 2018-19 is we onboarded a large number of chartered accountants, telling them that our proposition is to provide services to your customers. You have more than 100, 200 MSMEs you're dealing with. Each of these MSMEs have different needs. You come to us, right? And if we are able to solve that need, if we make some money, we will share some of the economics with you as well. So we made it commercially viable for the CA to work with us, because the CA was not, and we didn't go after the big CAs because the big CAs would have big armies who can do this on their own, right? But the smaller CAs, chartered accountants or CPAs, right, who basically could see that there is an opportunity. This customer could be given a loan because he is right for the loan, but the CA doesn't have the bandwidth or the ability to do this. He's sitting filing his returns, etc. Right? We told those CAs that why don't you give those leads to us? We will solve the problem. We will be your back office on getting it done. And if a deal gets done, we will share economics of what we make with you as well. So that's how the thought process started. So what the view was that look at your CAC, which is your client acquisition cost. This allowed us to work with a much lower. Actually did two things. Number one, it converted our client acquisition cost from a fixed cost to a variable cost, because we only paid when a deal got done, right? So otherwise there was no cost to us. And the other thing was that naturally the cost was lower than what we would have had to do had we put out a sales team of 1,000 people on the ground going and meeting every MSME, right? So I think it was a unique model on how we would approach the market and get that going, right? And that's what the company did for about 2 years. Yeah.
The lending was done from Neogin's books only.
Lending was done purely from Niyogin books, right? It was purely
Okay.
because this was an NBFC. We were trying to beef up the NBFC. NBFCs are only relevant if you have a loan book. So the lending was
Right.
being primarily from this thing. Now that was phase one of Niyogin, right? And I
And
think phase two
the
and phase three are
underwriting was
closer
like
to.
the traditional way of underwriting, like
It is the
looking at
traditional
the
way of underwriting. That's correct.
financial statement, GST
That's correct.
filings, etc.
That's correct.
Okay.
That's correct. That's
Okay.
correct.
Got
Right.
it.
So that's
Hmm.
how the business
And
started.
what was the loan book when you came in
I think it was
2020?
about 100, about 80 to 100 crores. It was not
Okay.
large,
Hmm.
but
Right.
no, it was actually a little lower than that. But when I came in 2020, we were right hitting the pandemic, and the first thing we did, like I told you, is we stopped it because we said that we don't know how small businesses are going to survive. It doesn't make us to start lending in this ecosystem. And the second point was that we were lending through the CAs, but the CAs weren't the best mechanism to collect, right? Because we didn't
Hmm.
build the big collection infrastructure when we were thinking the CAs will help us to collect. And therefore, we stopped the process and we said, let's first get our money back. Let's make sure this money comes back before some of these businesses shut down. Because in the pandemic, a lot of small businesses actually just shut down, right? A customer which shuts down is not going to pay you back the money. And you have no security here because these are unsecured business loans. So recovery
And
is
there was
just
also a
basically.
moratorium. You couldn't collect, right, for a couple of
Yes, there was a
months.
moratorium given by the regulator. We had to give the moratorium. Those were all given in. We were absolutely kosher as far as the law is concerned. But it just created the moratorium did not mean that the companies survived, because those companies that were not actually at the end of the moratorium, they were in a significantly worse off situation, because they would have spent another 8 9 months of not doing any business, right? But they would all have had some cost. कोई दो लोग बैठे हैं, तीन लोग हैं, there's got some staff, some rental that they have to pay, etc., right?
And
And
the
there's no
interest
revenue coming in.
interest is also piling up. Hmm.
Yeah, and interest was also piling up. Just because there was a moratorium doesn't mean that the interest meter did not continue. The meter continued. It was a cash flow moratorium that we
Yeah.
can't collect the money from them, right? So good or bad, I have my own views whether the moratorium was a good thing to do or not. But nevertheless, it was, like I said, it is what it is. We can sit and debate whether it was the right thing to do or not. It doesn't matter, right? Because that is just in the realm of theoretical discussions. But I think what came out of that was that we went back on the drawing board in 2020 when I came in, and we said we need to think through that lending can only be done if we have incremental information that allows us to be different from the rest of the market. Otherwise, we were too small in the ecosystem, right? What is the point of being a 80, 100 crore NBFC? It's an irrelevant number, right? And you can't keep scaling up with the risk that if your collection infrastructure is not strong, right, you will get impacted materially, right? So I think two things happened in 2020. We debated that whether we should do the lending. We actually debated whether we should be in the lending business or not, right? And we said let's pause that discussion right now. Let's look at what are the other opportunities, because the capital was still safe. Our capital was still there. The money was still available. And as we collected our money back, right? Of course, there were a few losses, but we collected our money back. We were sitting on cash, right? So the first thing we did was we started actively managing our treasury to make sure that we are deploying whatever money we have effectively to at least generate some income rather than just making a FD return. So that's the first thing we did. We created an active treasury in 2020, and in 2020 we also acquired iServeU, which we felt was an interesting technology business, which was meeting the needs of what we thought the country would need in the future. And to me, that was, I think, one of the best decisions we took while coming in. I think both decisions, in my view, turned out to be good decisions. One was to stop lending at that point in time till we figured our lending ecosystem and what is it that we need to do, and to buy iServeU, which was again buying a business very early in its stage of evolution. It was a small company, 20-25 crore top line, very, very young promoters, enthusiastic people, excellent guys we got on board, right? Great talent, right? In the ecosystem that we got. And both these decisions basically then charted out our path as the world came away from the pandemic. By 2022, we had first figured out for the iServeU business what should be the right strategy. Because when we acquired the company, there was a certain strategy that the founders were working with, right? And that strategy would have hit a roadblock. And we worked with the founders and we figured out what the new strategy of that company should be, given that there was a tech development capability we had, right? We identified the white spaces that we should be focusing our energies on, which were not necessarily changing the whole path of the company completely, but making some tweaks and adjustments to make sure that we have a green run in the growth of that company, right? And that's turned out to be pretty good for us. And in 2022, we also figured out on the lending side what is really the place where we can be differentiated and create an ecosystem of players that we can probably play with, and use technology on both elements of our business to be differentiated. So 2022 really marked the restart of our business in some sense,
Hmm.
right? And so people say you are a 6 7 year old company, and I said we are a 3 year old company. We are not a 7 8 year old company. We are sitting, from 22 is really when we restarted or repivoted our business. and the benefits of that we are seeing right now. In the next couple of years, you will see material benefits of those strategies playing out, right?
So iServeU is like 100% subsidiary.
No, iServeU is a 51% subsidiary. 49% is owned by the founders of iServeU, which we wanted the founders to also have skin in the game. So they are fully deployed. All the founders are completely involved in the business. They are actually managing the business. I am on the board of that company. We sit on the board. They report into me on an operational basis. They report into me, and we have a great working equation. So that's been pretty good.
And let's kind of like first talk more about iServeU. So
Sure.
what is the how do they make money? What is the product offering?
So again, I won't bore you with the evolution because there has been an evolution out here. But what we do today is iServeU has become what I called an API infrastructure company. And I'll tell you what that means, right? So if it's basically an infrastructure company today, which has the capability to power anyone who wants to sell financial services in their ecosystem. So take the example of you are a Hindustan Lever distributor, for example. You're a Unilever distributor. You're selling soap to, let's call it, 100,000 retail outlets, right? They're buying soap from you. These are kirana stores or mom and pop grocery stores, and you want to do more with those stores. You need technology to do more with those stores, right? So if you want to start converting each of these stores into effectively a bank, which means customers should be able to walk into these stores and perform all banking transactions. They could withdraw money, they could deposit money, they could do a funds transfer, they could apply for a loan, they could open a bank account. That entire tech stack iServeU provides. So iServeU will provide the tech stack to the lever distributor. The distributor will then talk to these his retail stores and convert them into effectively bank outlets. We call them as banking correspondents in Indian parlance, but they are all transaction enabled banking correspondents, and they are bank agnostic. That means they are not linked to any bank. You could have an account with any bank. You could have an account with Axis Bank or ICICI Bank or what have you, and you could go into these retail outlets and you could do transactions, right, which will get eventually debited from your bank. Now all this was possible because why this opportunity came up in 2014 when the government created MPCI, which is the National Payments Corporation of India, that allows for some of these things to happen. So what we are doing is we are extending the power of MPCI by providing the last mile connectivity. The last mile connectivity is what iServeU provides, right? But iServeU, again, to go back to my original philosophy of always looking at our cost of client acquisition to keep it low. If we were to go after every retail store, I would have had to hire thousands of people on my ground. We have less than 20 salespeople. Because the way we do this is we'll end up working on an enterprise basis as against a direct retailer to retailer basis. So I'm happy for anyone who wants to be an aggregator of retailers and he comes to us, we are happy to give our technology to them. And the way we make money is we make money on every transaction that gets routed through us. So if you are a customer and you walk into a small kirana store in some village in Bihar and you want to withdraw 3,000 rupees from your bank account in Bombay with Axis Bank in Bombay, you could walk into that kirana store, right? You could tell him, I want to withdraw money from my bank account in Axis. You don't need to give him the bank account number. You need to just give him your Aadhaar number, right? And your fingerprint, because your Aadhaar number and your fingerprint is anyway integrated with your bank account. We pick up that data in a secure manner. We provide that data in an encrypted manner to MPCI and to the bank, right? Or to MPCI through a switching capability which requires authentication, which is also our own switching capability, validated and verified and approved by MPCI. MPCI sends that transaction to the bank. The bank will validate and say, okay, yes, Akshay has 3,000 rupees in his account. And that message then we relay back to the kirana store or the grocery store guy. The grocery store guy then takes out 3,000 rupees from his register and gives it to you. What you have done is you have taken 3,000 rupees from your bank account with Axis Bank in Bombay, but the Kirana store guy has acted as an ATM for you without the need of any fancy technology of a big machine out there like an ATM machine that we go to, which needs to be filled up with cash, right? It is a non-human interaction. Here you've converted that into a human interaction. And what have you achieved? You achieved three things. A, for Akshay, we've made it easy for him to access his bank account from a remote location without having to authenticate him 20,000 times. Right? His fingerprint, which is unique to him, and his Aadhaar card, which is also unique to him, is the only way the authentication happens. Right? Number one. Number two, what we've done is we have provided a solution to the Kirana store or the grocery store by telling him that you can actually make the money that you collect every day selling, atta dal chawal, whatever you're selling. What do you do with that money? That money you have to go deposit in a bank. It's a dead asset. We have suddenly made it productive. By giving you the 3,000 rupees, he's able to get rid of that cash, and we pay him for doing that transaction. So he gets paid, let's call it 10 rupees for doing that transaction, right? Suddenly, out of nowhere, for him, it's become an income augmentation idea because he's now making money, right? And where do I get paid? What have I done? I have enabled a customer of Axis Bank getting served because you are a customer of Axis Bank. I have served you on behalf of Axis Bank. Axis Bank pays me, let's call it 15 rupees for doing that transaction. So I'm getting paid 15 rupees. I'm giving part of that money to the Kirana store guy. He's happy. You as a customer are happy because you've not paid me a penny for your 3,000 rupee withdrawal. You've not paid the bank. The bank anyway is making money off you because your deposits are with the bank. So the bank is happy because I have told the bank, you don't need to create a banking infrastructure in a small village in Bihar because you know what? All your customers, I'll make sure will get served through the local Kirana stores in that place. So you've solved multiple problems out here. You solved the bank's problem of not having fixed cost expense. You've converted their fixed cost expense into a variable expense. You solved the Kirana store's problem. He's sitting on cash. He doesn't know what to do with the cash, right? And therefore you were telling him to dole out and make that cash productive. You've solved Akshay's problem, who needs access to a bank, and there may or may not be an ATM in the location where he's based for him to go and take out money. So you are solving multiple problems using technology, right? And it is a net value productive proposition because everyone in the chain that is providing service is getting paid.
I want to ask a couple of questions here on this. Uh, so the identity verification is fingerprint. So all these shopkeepers are issued some sort of a fingerprint device,
Yeah. So
fingerprint
the
reading
shopkeepers,
device.
that's so now I think the question to ask is what is the investment required by a shopkeeper to be in this business? Right? A fingerprint verification device costs 800 rupees.
Okay.
Right? That's it. They need to spend that 800 rupees to buy that device. We provide that device. I don't give it free of cost, right? Because we think that people want to be in this business, they need to have some
Skin in
investment.
the
It's
game.
not a big deal, right? And if the
Yeah.
customer is get if the Kirana store guy shopkeeper is getting paid 10 rupees per transaction, right? You're talking about 80 transactions for him to break even. And the fingerprint device has a 3 to 5 year life. So you're talking
And
about
plus,
he can break even in the first month itself.
this needs to have a SIM in it also. I mean, it needs to be internet enabled.
Yeah, it doesn't need internet enabled. I think it just requires basic phone connectivity. It
Okay.
requires
Okay.
phone
Okay.
connectivity. It doesn't need to have broadband or any of that. It needs to have,
Hmm. Hmm.
but India may, thanks to Geo and some of the other players, there's no
Yes.
issue with the internet connectivity in any
Right.
place.
Right. Right. Right.
So
And
everyone has a cell phone.
it
There are
is.
more than 500 billion cell phones, for 500 million cell phones in the country. So everyone has a cell phone. The cell phone can be used to enable this transaction as well.
Okay. Okay. And the fingerprint that it is comparing against is when you have enrolled for Aadhaar at that time, you give your fingerprint. So
That's
that's
right.
what. It,
That's right.
okay.
That's right.
Okay. Okay.
Right. That's right.
Okay. Got it. Got it. This kind of an ATM, this Aadhaar based ATM, is in itself an industry, right? I've interviewed Spice Money
Yes.
founder
Yes.
previously, and I think they have a significant presence in this
Yes.
kind of
Yes.
a.
So
Uh,
the difference between us and Spice Money, just to since you bring it out, is that Spice Money is the person who will deal with the retailer. I would be providing the technology to a Spice Money. Right. So our reason I explain the process to you is because you need to understand how it impacts the individual consumer's life. But I am not dealing with the Kirana store guy. I am not dealing with the retailer directly. Spice Money, Pay Nearby, these are companies that are dealing with the retailers. I am at the back end providing the full infrastructure for them to be able to use this so they can focus on building. Now they've also got some part of, so Spice Money is not my client. So in full disclosure, they're not my customer today. But people who are competitors to Spice Money are customers of mine today.
Okay, got it, got it, got it. Uh, and I've previously interviewed the Eco founder also on this
Yes.
podcast. So Eco is also a technology provider, or they are also in the retailer space.
No,
Like,
so Eco was a technology provider, right? And Eco was also trying to get into this space by extending the APIs of the banks, etc. I think Eco's somehow I don't see them in the market anymore right now. So I don't know what's going on with that company. We
okay,
don't hear about them too much right now. But yes, they were
Okay.
in the same space. They were also a technology provider. They were similar to us,
Hmm.
right? But we don't hear of them as much in the market. So I don't want to give you something
Got
which
it.
is
Yeah.
incorrect, and
Understood.
when I'm not plugged into something, I don't want to talk about it. We
Hmm.
looked at
Okay.
Eco as a potential acquisition almost 4 years ago, right? And then we decided that we can build all of this ourselves. And between the build versus buy, we took the build decision.
No, but you bought iServeU, right? In a way.
Yeah,
So,
yeah.
so
When
within
I meant,
iServeU, okay.
yeah, yeah, I think
Like when you say
iServeU
we,
took the
you mean like
decision. Yeah, yeah.
iServeU took the decision. Ah,
iServeU could
interesting,
have
interesting.
done
Okay.
the build versus buy, right? So
Uh,
because and
okay.
now what has happened? So that was phase one of iServeU,
Hmm.
right? Today, what we did after that is this is actually the lowest end of the food chain in the financial services space. The
One
financial,
last question, sorry, before we
correct.
move on to phase two. Uh, how is the money getting split? Because now there are multiple players here. The bank will pay something, like say 10 rupees, hypothetically, for this
Yeah,
transaction. Something
yeah,
goes to the retailer, something goes to
yeah,
iServeU, something goes to, let's say, a pay nearby, who is your
yeah,
immediate
yeah,
client.
yeah, yeah, yeah. So the
How
way
does
it
that
works
money get
is,
split? Yeah.
so the way it works is that if suppose now Pay Nearby is not my customer, but just as an example, if you look at Pay Nearby as an entity who we have provided the technology to, Pay Nearby will eventually pay the retailer. It's between Pay Nearby and the retailer what they have to deal with the equation, right? What I'll end up doing is I'll end up giving between 90 to 95% of the economics to Pay Nearby
So the
because
bank
I'll
will pay
just
you. Bank is
the
paying
bank will pay
iServeU.
me. The bank will pay me. The bank will pay iServeU. Bank will pay my bank actually. Banks only pay other banks, right? Banks will because my switch with MPCI has been sponsored by another bank. That bank will get the money from the bank through which the transaction was done. My bank will pay me. I will then, depending on who I'm working with, between 90 to 95%, I would end up giving the economics to them. So, because the person who needs to get paid the most is the person who's closest to the customer. In the food
Right.
chain, we are the furthest away from the customer, right? But we
Hmm.
are also a technology service provider, which means for me, scale matters because every incremental transaction has no incremental cost to me,
Hmm.
right? So as I move last year, for example, just to give you an idea, in 2024, we would have done almost 45,000 crores of this throughput through our pipes,
Wow.
right? So it's not
Amazing.
small; it's a pretty significant number. Now we'll end up making 4-5 bips in the overall ecosystem, which is fine. But when that 45,000 crores can become, 450,000 crores, the economics start becoming so much more. So our motivation is to create the pipes, right, and then sit in an ivory tower and keep clipping away because every transaction that moves in, I have no incremental cost. I can make money.
Though there is I'm just thinking as an outsider, like eventually everybody will start using UPI, and these services of withdrawing cash will become irrelevant, because even in a tier 3, why do you need cash if through your phone you can scan and pay,
Yeah,
and
I think.
internet is
Yeah.
so cheap? So
Totally, totally. And I think that's a question that every investor asks me when we go and meet our investors. And I think the answer to that is actually broken up into 3 or 4 points. Firstly, I think you should understand the cash in the Indian economy, right? Because theoretically, what you're saying is absolutely right. But in reality, post demonetization, in demonetization, the cash in the Indian economy had come down to about 7% of the GDP. Today, the cash in the Indian economy is 14% of the GDP. And the GDP has tripled from what it was then, right? So the actual physical cash in circulation has gone up through the roof quite materially. Number two, UPI, while everyone thinks UPI is free, UPI is not free, right? For a consumer, you and I, UPI is free, but for you to do UPI, you need to get a UPI handle. For a UPI handle to be given to you, a bank has to give you a UPI handle. The bank has a cost of the UPI handle, right? Number one. Number two, UPI has its own set of challenges in terms of
so
reconciliation
this
between.
this is currently being borne by let's say Google Pay is bearing the cost of the UPI handle today, because
Exactly, exactly.
Google Pay is closest to the consumer, so they will
Yes,
bear the
yes,
cost, because they will
yes.
eventually like sell a credit card or a loan or something
They'll sell
to.
something else. They'll sell cross sell
Yeah,
because UPI itself,
correct.
Google Pay can't make money on that. It's a cost matter,
Hmm,
right? But they have
got
to do
it.
a cross sell to be able to make money on that, right? And the consumer is having a free ride, right? You and I are not paying for the UPI product, right? Because the government's made sure that the consumer, which is also one of the reasons why UPI has gone through the roof. The problem is that if you want cash, UPI doesn't solve your cash problem. UPI solves your fund transfer problem. I need to pay Akshay, I can pay through this. But what if Akshay wants physical cash?
Hmm.
Because when you are and that's why this opportunity or this whole thing was originally thought through from a rural India standpoint. right? And in rural India, a lot of transactions are physically done in cash. There is a person's personal comfort of having cash in hand, right? Some individual behaviors are not going to change overnight, because if UPI has changed the way things are working, why is there more cash in the economy compared to what it was during the demonetization?
Mm.
Excuse me. So that's number one. Number two, I do want to tell you other thing which you need to take into account is that in rural India, a lot of people, these accounts are loss-making account for banks. People don't keep too many balances and all of that, right? So the banks really don't make any money, and therefore they are not dying to go and give a UPI handle to each of these people, right? And therefore that's the other reason why you've not seen UPI. In fact, MPCI launched UPI Lite or UPI 2.0, which was largely for it to be. It's not worked. It's not been successful at all. So UPI has been a super success in urban centers. I'm going down to have a cup of tea. I can pay for the cup of tea 20 rupees. I can pay through UPI, right? That's perfect, right? So I don't need to carry any cash in my wallet because we are sitting in the urban centers. I think rural India is a completely different kettle of fish. One needs to break up India between India and Bharat, right? I mean, it's a term that's been much maligned, but Bharat operates very differently from India, right? And somehow, unfortunately, all the intelligentsia is sitting in India, and therefore, on the theoretical models show that there should be no cash in the economy, but reality on the ground. Because I travel into these small cities, right? I travel, I meet customers in these small cities. We understand the behavior of these customers, right? Plus, what happens is that moment, one of the big, I must give you this example, right? Because India has elections all the time. And in the elections, Maharashtra elections, for example, which just concluded, one of the biggest reasons why the current government won is because the government had a scheme called Ladki Behan. They were giving a certain amount of money to every woman on the street as a sustenance allowance, right? And that became a huge success. BJP also did that in Madhya Pradesh, and it was a huge success there as well, right? But what do these women do when you transfer the money in the account? Firstly, I think what technology has done, the technology has taken the middleman out of the equation. So if the government is sending money into my maid's account, that money actually genuinely gets into my maid's account. What does my maid do with that money?
The
The
leakage
first thing
has gone out.
the leakage has gone out. But what does my maid do with that money? The moment the credit comes in, she goes and takes out that money into cash. The next day, she does not leave the money in the bank even for a single day, right? Because her belief is that no, I need the money, right? Because it's only 1,500 rupees or 1,000 rupees, whatever the number is. I don't know the exact number per month. They go and take out that money. Now, moment they take out that money, then it becomes a cash economy. Then she's going to spend the money, right? And therefore, the cash economy is not going away. It is getting muted, which is one of the reasons why we also thought through, and now coming to the phase two, we figured out that this is not the only mainstay. This is also the, like I explained to you, the lowest rung of revenue generators or profitability generators for financial services, right? It looks sexy because it is solving a real problem, and it has solved a real problem. And companies like Spice Money, Pay Nearby, all of these have been contributors to solving this problem. So, right, no one is taking credit away from anyone. They've all collectively. India is such a large country, right? All these businesses can coexist and thrive because the market space is so big. But what we did as a strategy is we figured out that if we need to be the true API infrastructure company, then we need to go beyond these products and create the ecosystem of the financial services that need to be done, right? So what we did after that in 2022, Niyogin invested another 50 crores into iServeU. In March of 23, sorry, not in FY23, we invested, and the idea with that money was that we need to now build the next wave of product capabilities which go beyond these, and start looking at those products where there is a significantly higher revenue or profit generation capability for us. So we landed up, what did we do? We landed up building three or four things. We landed up building the entire card infrastructure. So if anyone wants to issue prepaid cards, credit cards, etc., we are able to provide them a plug and play approach today, which has got nothing to do with financial inclusion, by the way, which is a complete financial services place where, because one of the things we also felt was that, you have maybe 100 million people in the country that can potentially be given credit cards, right? But you have 900 million people that are being given debit cards. We felt that prepaid card could be a significant opportunity. Loyalty cards, prepaid cards could be a significant opportunity. And someone had to make sure that there is an engine that can manage this entire ecosystem, right, of managing the cards, etc. So we created that as our next product. Similar to that, we created the credit card engine because we said that this needs to be done. Also, MPCI in the meantime launched RuPay as a network to compete with Master and Visa, right? And by the way, if you go back into the global environment, you'll find every country is trying to launch their own network. Middle East has launched another network which they want to compete with Master Visa. So we were fully integrated with RuPay as an institution, and we can issue cards on RuPay and also Master and Visa now. Whether it's a prepaid card or credit card, we can't issue because we are a tech company, right? But because and we don't have licenses to issue cards.
You work with a bank.
But a small finance bank wants to suddenly get into the cards business, we could power them up in the plug and play approach. We just did a small deal with a football company, with a football club, the Orissa Football Club, where they wanted to start issuing prepaid cards to their fan following. So they have a fan following, and we gave them prepaid cards which had photographs of their main stars, etc. Preloaded cards where they could preload the card and then use that for buying merchandise,
Hmm. Okay.
right? And for every time the transaction happens, there is an MDR that gets computed, and we get a share of the MDR. So the economics of that transaction are significantly better than the 4-5 bips you'll end up making as your net revenue in a financial inclusion transaction, right?
The bips here, and let me just clarify bips for our listeners. So bips is basis points, which is like
Yeah,
uh, 0.01% is one bip,
that's
basically.
right. That's right.
Yeah. Okay.
That's right.
So
So
the
so
bips here
so
are better
bips here are much
in
better
this.
in this.
Okay.
Yeah. So for example, if you make 4-5 bips in the financial inclusion transaction, here you could make anywhere between 18 to 20 bips. Right. So you're talking about four,
Okay.
five times the revenue, right? That you could make
Hmm.
potentially as your net revenue, which you would want to keep, right? So
And the
I think
revenue is only bips, or also per card issued? Is there some
no, of course,
fees?
there is per card issued as well. There'll be a per card issued. You'll charge a small fee for all of that, right? So I'm just computing everything, putting all of it together. 18-20 bips is what we would end up making.
And you provide the bank partner here, like to that Orissa club?
Yes, we provide everything. It's a full stack.
Okay.
One of the big
Okay.
things that I learned in my business is that you cannot go to a customer unless you have a full solution. You cannot go and tell the customer that, listen, yes, I know you need this, but I will only solve this one problem for you. Balance, you please stitch all the other pieces together. Now, I don't need to solve every problem. I need to stitch it together. I need to make sure that he can get activated on day one. So if it requires me to have a switch which is authorized with MPCI, it requires a bank to sponsor the switch. It requires someone to be able to do the reconciliation. Requires somebody to be able to do. Whether I do it myself or not is not relevant. I will provide the full solution to the customer. So when I go market, some pieces I'm handling, some pieces I've arranged.
And which bank do you work with? Is it one bank or like many
No, no, we
banks?
have
Like,
more than 15 banks we are working with, right? So there are more than 15 banks we are working with. Of course, some of the larger banks we work with, we work with Kotak, we work with NSDL Payments Bank, we work with India Post Payments Bank, right? We are doing a big project with Canara Bank, and some of the other banks are there. So we've not, and that's all come through as part of our phase two, phase three of our line of business, as I will explain to you shortly, right? So so we moved up the chain, right? We
one,
got into.
sorry, one or two more questions I have here. So in this business, you are competing with, like, say, an M2P.
Yes, M2P is our biggest competitor in this business. That's right.
Hmm, okay,
Right. So
okay.
M2P
And
would be a
what about this
big.
company called Hyperface? They are also in the same
Yes, they
space,
are
or
also a competitor. Yes, they are also a
okay,
competitor.
got it.
Right. So
Okay, understood.
the difference is that we don't compete with them in the financial inclusion space. We have entered their domain. If you really go back into origination, how these businesses came up, M2P started with the cards business, right? That was their core reason. Same was Hyperface, right? We started with financial inclusion. We are now entering their domain just like they can potentially enter our domain, except that they've taken a different path. M2P has acquired more than 6 companies over the last 4 5 years, and M2P has gone into things like core banking solution for banks, etc. Right? Whereas we are not. I mean, what I hear is for Unity Bank, they are providing the core banking solution, right? In which case they are competing with an Infosys because Infosys has Finacle, etc., which is the core banking solution. We are not doing that. We are not getting into that big space. We still think that being a microservice provider is the way to go for us rather than becoming the full stack solution provider for a bank saying that we'll also do your core banking. They acquired a company that had the core banking solution, right?
Hmm,
So it's not something that they've built from scratch. It's an acquisition that they did.
right. I guess
But
Zeta also started with this card issuance only, right? Like
Zeta is
how
very
it
interesting.
originates.
Zeta basically started with a prepaid card issuance, which was a Sodexo solution,
Hmm.
right? Sodexo was Zeta's proposition, right? And Zeta has Zeta has a strategic tie-up with HDFC Bank. They provide the services to HDFC Bank, but what I understand is that part of that contract was that they would not work with any other bank in India. So they are not working with any other bank in India, but they work with HDFC, and I think HDFC works with them. So there is some kind of a, and HDFC is a big bank, as you can appreciate, right? So,
Right, right, right.
but Zeta therefore is now going overseas. They're talking to international players, etc., and they're trying to see how they can scale that business globally, right? But they started with a prepaid card stack, which is a Sodexo card, which is now called Pluxee. That brand has been renamed to Pluxee.
Okay, okay. Pluxee is owned by Zeta. I did not know
Yes,
that.
yes,
Okay,
yes.
okay, okay,
So,
okay. Got it.
so that's
So you're talking of the diversification. Yeah, moving up the
yes.
value chain.
So we
So
got into
cards is the second thing, right?
cards was the first thing. We got into bill payments, right? We got into BBPS, which is again an MPCI product, right? We got into
What is
cards.
that? Just
No, bill
for
payments,
an.
powering people for bill payments, right? See,
Hmm.
point is when you want to be a super app, you need to have the ability to provide all kinds of solutions to customers, right? And bill payments is a big opportunity in India because everything is all bills are now getting digitally generated, right? Whether it's a phone bill, electricity bill, your stamp duty bill, whatever the case may be, are all. So bill payment is a big opportunity. We are also in.
And
Our
what has
proposition is
NPCI
to.
done here? Like NPCI
No,
is
no.
connecting the bill issuers
Yeah,
together
NPCI is
on a
connecting the bill
platform.
issuers with so the NPCI is connecting the bill issuers, so you can get bills coming to you on your computer through your bank account, right? What we are doing is we are creating the infrastructure for enabling people who want to have bill issuers or to pay bills to be able to provide the capability. So if you have a bunch of retailers and you want, so take the example of the Hindustan Lever distributor. If you want to pay your electricity bill with cash, right? I want to pay 300 rupees electricity bill in a small village. I could walk into a Kirana store and pay the 300 rupees and my bill payment could be done there. I don't need to go to an MTNL or to a BSES location to collect the bill. 10,000 retail stores have suddenly become enabled to become bill collection centers,
Hmm.
right?
Got it.
Now, if I want to do a digital payment, I don't need to go anywhere. I can do it on my computer. But if I have physical cash and I want to make the bill payment, I need to go somewhere. Someone needs to take the money from me.
Hmm. Hmm. And this would be linked with your phone number. Like you give your phone number
Yes.
and he will tell you what all bills are
Yeah, there are multiple
due.
ways of doing it. There's Aadhaar card, there's phone number, etc. So there are multiple
Okay.
ways in which that can be, raised, etc. So,
Okay.
I mean that was bill payment. Then there's a card issuance. Then what we got in was the current line of business we've got in is, there is the whole on the card side we spoke about issuance, right? Because issuance of cards that we were doing, we also got into the acquiring side of the cards. Acquiring side basically means that you provide the devices that will be used to verify the cards, right? The POS machine devices. So we said we can also be on the acquiring side. On the acquiring side, we figured out that for UPI transactions, one of the innovations that came in, which I think I would probably credit Paytm to come up with the innovation, right? And Pine Labs followed suit, was to create what are called sound boxes. So when you walk into a small kirana store, you swipe, you pay through UPI or 200 rupee bill, there's a voice that says 200 rupees received. So the Kirana store guy does not need to validate or take a photograph of your screen to see the money has been received. He's actually got a message which says, and it just creates efficiency in the system, right? That soundbox, while the hardware is a very small piece of equipment, it's a simple speaker, right? The technology is quite complex because what happens is that the information, the UPI transaction has to go to the switch, has to get validated that the transaction is completed. Then it has to come back to that same Kirana store, and then the voiceover can work that this money is received. And all of this has to happen in split seconds. So we created that technology as well. And we are now able to provide sound boxes with that loaded technology on the acquiring side to banks. So one of the large PSU banks has given us an order of say 500,000 sound boxes to be delivered over the next 2 years, and that suddenly has become a huge business for us because that business has created what I call a SaaS revenue. So at some level, if I break the business again on iServeU, I now look at it vertically on two aspects. I vertically look at banking as a service and I look software as a service. So there is a BaaS revenue and there is a SaaS revenue. All that I do on the financial inclusion side, wherever I'm converting a Kirana store into a effective bank, that is banking as a service. I am providing banking as a service to the end customer. If I'm providing Soundbox or some technology to a bank, right, where the bank is using that technology, I call that software as a service, right? So we have both of these streams. In the banking as a service, I have people I need to feed. I need to make sure the Kirana store guy gets paid some money, the pay nearby equivalent gets paid some money, etc. In SaaS, all the revenue comes to me. I don't need to share it with anyone, right?
Mm.
So, so those two streams of income have become relevant for us, right?
How are
And
you monetizing this Soundbox? Is it a one-time sale that
no,
500,000 sound
no, it's
boxes?
no. It's not. It's a
Okay.
one-time sale, of course. Now there
Mm,
are two models that work out there. There could be a model, and the 500,000 deal is a straightforward deal where we are giving the devices, we are making a spread on those devices, right? Make whatever 200, 300, whatever amount of money you can make per device. But more importantly, you have a software cost, which is a cost that is paid on a per month per device basis to us. So on a per month
Okay.
per device basis, we are getting paid. That is what our core value is, right? That's what we should be getting paid for. They could have bought the
Is it like
devices themselves.
double digit or triple digit that per device per
In
month?
rupees, it's double digits.
Double digit. Okay.
Double
Mm.
digit rupees.
Like teens or something like that.
Well, it's more than that. It's more than that,
Okay. Okay.
right?
Hmm.
And it's more than that. So obviously, I don't want to get into the actual numbers, but the interesting part is that is just annuity revenue. I have no cost.
Yeah.
Because the software is already built. It's just loading the software on that device. The device is deployed. Life of the device is 3 to 4 years,
Mm.
right? And I've already got the device paid for, right? Because on day one, I bought the device for, call it X plus 5% or 10%. I've sold the device, so I've got paid that money. I have no cost of the device. I'm not keeping it on my balance sheet, right? And I just clip away my, call it 18, 20, 30, 40 rupees, whatever that number is, right? I'm
Mm.
clipping away month on month basis, right? And at the end of 3 years, 4 years, when the device needs to be replaced, I'll give a new device, and then I will keep clipping away that software fees, and there is some escalation on the software fees as well, right? As
Very
per the
nice.
contract, right? So
And
that has
the
created
bank would also similarly charge the retailer like a monthly fees
exactly,
plus a one-time
exactly,
cost
right,
or
exactly.
something like
And
that.
what we've done, so our model is slightly different than the Paytm and the Pine Labs out here because Paytm and Pine Lab were basically selling to the retailer directly, which means they had
Yeah.
to then collect from the retailer directly, right? Which
Which
is
is
not
not your
necessarily,
DNA.
which is
Your
not my
DNA is to
DNA.
go
You
through a
understood my
partner.
DNA, right?
Yeah.
Correct. No, no. In this case, we are dealing directly with the bank. The bank is my partner. The
Yeah.
bank wants to give that device to the retailer. That's between the bank and the retailer. I don't care. The bank buys from me. He gets a fully software loaded device, right, which he can deploy, and the device connects directly onto the main system and is ready to go on day one itself, right? The integrations are all done. All those devices are integrated on the bank's system. Now, here the bank could use its own UPI switch for doing those transactions, but for the smaller banks, we are also offering the UPI switch. So what I'm telling the smaller banks, like a bigger bank, will say, "Listen, I'm already doing UPI transactions. I don't need your switch. Just give me your Soundbox solution." Whereas a small bank would say that, "Listen, I want to offer the full solution to the Kirana store. So please give me the UPI switch as well." So we are now enabled. So again, going back to the DNA, my DNA is always be ready with the full solution, but offer it as a microservice, which means a customer can pick and choose that I only want part A, B, and C of your solution. I don't want part A to Z, right? But A to Z is also available, obviously at a different cost, right? The price is different if you want to use A to Z. All of my solutions you want to use for that solutions, we can use that. So I think the point I'm making is that we provide the whole stack, but provided not forcing the customer to buy everything from us. Tell him that everything is available as a microservice. You pick and choose. We'll give you only what you need, right?
And
And I think, and I tell you, customers love that. My own experience dealing with customers, they love the fact that we are flexible in giving them exactly what they need because they think that they're paying only for what they need, which is what it is.
I think a good way to look at it is that a Paytm is like an Amazon, and you are like the Shopify.
Yeah,
Like you are enabling others to do like fintech, whereas Paytm
yeah,
is directly doing fintech.
yeah. I don't want to comment on your analogy, but yeah, I think you're not far from the way I've positioned it to you right now. But yeah, that's how it is. So the difference is that I am not dealing with the retailer. I'm dealing with the bank, right? A Shopify is still dealing with the retailer in that sense. So
Ah,
there's a
yeah, yeah,
slight
yeah.
distinction
Right,
there, right?
right, right, right.
And the beauty out here is that I don't then get into any receivable issues, etc. Because I'm dealing with a large institution who's buying from me, they pay me, life is good. The other model that operates in this market is where the bank says that, listen, I don't want to give you the pay for the devices. What you do is you load up into a rental model for me and you take rental over the next 3 years. Then I have to keep the device on my balance sheet. Now what is
Okay.
happening is that we are getting into a few contracts with a few banks where the banks are asking us for that, especially when the cost of device is large. See, if the device cost is about 12, 1300 rupees, the banks don't mind paying for it. But if the device cost, and there are different technologies and different capabilities of different devices. One of the devices we work with is a 8,000 rupee device. So a lot of
What
banks
is
are telling
different
us.
in that? Like
I
that's
think
like the
there is a.
touchscreen card device, is it?
It's got touchscreen. It's got multiple capabilities. It can do biometric as well as card reader device. So it's an
Okay.
all-in-one device, right? Which we have also designed along with one of our partners. In fact, when we were in Singapore Fintech Festival about a month ago, we actually signed an agreement with one of the larger device companies in the country called PAX
Okay.
devices. And there we are now working with them to develop what we think would be the new age devices required for the country. There, the larger cost devices, which are 7, 8,000 rupee devices, the banks come and tell us that, listen, give us a rental model. We don't want to pay you so much of capex right now, because we'll also collect. Because for them to eventually, they need to collect the money from the retailer, right? If the retailer is saying, "Hey, boss, I'm not going to give you 8,000 rupees in one shot, but I'm happy to give you a rental over the next 3 years. So give me a rental model." So that's something which we are debating right now, because the opportunity set is there for everything, right? We have to pick and choose
Hmm.
what battles we want to fight.
Right.
And if the economics make sense and the rental yields are okay, then we could potentially do some of that. Right. By
And
the way, Pine Labs and Paytm used to do a lot of that,
right.
and
The
they potentially
Pine
still
Labs
do.
would like directly go to the retailer and give them the
That's right. They
device,
go to
right?
the
The
retailer, but
costs
they would not sell the device to the retailer. They would do a rental with the retailer.
rental. Right.
Right.
This
So
in this space you are competing with an Easy Tap, I guess. Easy Tap also works with
yes,
banks and gives them.
EasyTap also works with banks, but I think there are other players who are focused on the. So I think you need to draw the distinction between the POS device and the Soundbox device. Pine Labs was
Hmm.
largely in the POS device category, which is the
Yes,
point of sale
right.
device. What we are doing is
Yes.
an add-on to the POS. The
Hmm.
Soundbox is an incremental microservice that you're attaching to a POS device or to a
But
UPI. Sound.
this 8,000 rupee device must be a POS device,
It's
right?
eight
With
thousand
a
rupee device is a POS with an integrated Soundbox
right. Okay.
device, right?
Hmm.
Yeah.
Hmm.
So
Got
it's
it.
it's
Got it.
it's
Got
one
it.
of those ones, right? So I think
Right.
bottom line is that that's the next line of business that we done. So you got the BaaS, you got the SaaS, right?
Hmm.
And each of these businesses are growing in their own right. Now,
Hmm.
what the interesting thing that's going to get added to the ecosystem is that suddenly the international market is opening up. We are now participating in the international markets. We've participated in the obviously the Global Fintech Festival in India. We've participated in the Singapore Fintech Festival. We've got inbounds from the Middle East. Right now, suddenly when you start becoming relevant, right, in the
Hmm.
markets, when you're dealing with 14, 15 banks in India, you're providing technology to these banks, you build credibility in the market. Suddenly the international players want to understand, okay, is there a way you can provide some solution to them, right, which could be more efficient from a cost standpoint, from their standpoint, but they would not deal with you till you had a certain scale to speak of, right, in your own home country. Today we have that scale in the home country. I told you about the financial inclusion, 45,000 crores of transactions done last year, right? We're talking about large number of soundbox devices being deployed by us this year, right? And also having the card stack, getting the first few customers using our cards infrastructure. So suddenly all of that starts creating credibility in the international markets as well. And today we've got inbounds from banks in from as far as Japan to, and I was telling you about Japan, right? I know you're based there. So from an institution in Japan to institutions in the Middle East to institutions in Southeast Asia wanting to come and do some POCs with us, proof of concepts with us. They want us to see, they want to see if the tech works, and we are obviously happy to engage with them. So I don't know how that will finally play out. Difficult for me to say because we are still at the proof of concept stage with a bunch of these institutions, but very, very interesting conversations, right?
Yeah,
And
how
and
much revenue will iServeU do this year?
so
Estimate?
iServeU will probably do a gross revenue of about 200 to 220 crores,
Okay. Hmm.
right? In that ballpark, right? So
Hmm.
that's what iServeU will end up doing. I think
And
this
when
number.
you put in that additional 50 crores, did you increase your stake beyond 51%
No,
or?
so we put it like a pref, like a
Okay.
redeemable pref share. So we didn't
Okay.
increase our stake because the point is our stake is 51.49. It's a sensitive matter because 51.49. The founders there have 49. I mean, eventually, the stake will come to us, right? Eventually, we will put everything together. Because when you're a 51% owner and you're a strategic owner, it becomes difficult for somebody else to come and buy that stake. I think right now we like the structure the way it is, and we don't like it also for reasons. But why we like it is because it has tied us together at the hip, right? We are involved in the growth of this company together. It makes sense for both the founders and for us to for this company to keep growing. right? I don't like it because I'm not able to aggregate the entire value of iServeU into my listed company. I can only aggregate 51% of that value into my listed company, right? And if this business continues to grow, and if the international business becomes real and we become a global company, then the value of that business could become quite significant, right? So at some point in time, we'll have to take that decision on what to do with the 49%, because sometimes, if the business runs away, then it runs away, right? We also need to have the ability to buy the 49%, right? Which we could do through a share swap and so on and so forth. But as iServeU grows, the value of iServeU anyway reflects in the value of our stock,
Hmm.
right? So I think the next
The
few years are
I
going to be.
guess the goal would be to do similar to what Tanish did with Carrot Lane. They eventually bought out the founder
Yes,
after.
yes.
Uh,
Yeah, yeah. So I think those are negotiations, right? Those are
right.
negotiations. But you're absolutely right. I think there are multiple options available on the table, and I don't want to bore you with that. You'll probably
Hmm.
hear about some of it in the course of the next 6 8 months, because this is a situation that needs to be in some ways unraveled, right?
Hmm.
But the beauty is that the value still agrees, will keep accruing to Niyogin. And what we've done is, in the last 2 years, we have put our heads down and we've built a lot of stuff, right? And I think parallelly we've tried to monetize some of it, but the real monetization is going to start from this year onwards. From 26 27 will be the 2 years. FY26 and FY27 is when the real monetization of the iServe business will start showing up, right? And that is where the real game starts becoming interesting, right? No one, I mean, the build is interesting, but the point is the build doesn't translate into numbers as much as we'd like it to do, right? Once the build is done, and like I told you, I don't like to give half-baked solutions to my customers, right? I don't want to go to them and tell them, okay, I've built piece A, why don't you use piece A and pay me for piece A, right? If their requirement is piece A, B, C, D, E, I need all that to be done before I can go and market that to a customer, right? So we took that call, and I have now more than 300 engineers in iServeU based in Bhubaneswar. It's a pretty large team we've created, right? And our product development capability is par excellence. We have some extremely high quality talent that we've been able to acquire, right? And what we also did in Niyogin, now going back to the mothership, right? We also acquired a small AI company, right? It's called we call it Niyogin AI, where we bought a toolkit from an AI based machine learning toolkit that we bought from a local player in India, the company called Orbo, that had built a toolkit, which is what I think one of the best OCR technologies I've seen comparing to all the other available in the country. And we bought that because we were thinking of using it for our processes, and we figured that if this toolkit is so good, why don't we buy it and productize it? Why don't we use that as a product proposition which we can add to the our repertoire of all the products that we have? So these small tweaks we will keep doing in our business model to try and see what is good that
Have
can
you
add
started
up.
selling that OCR tool?
Yes, we've already started selling. We've already got customers. We've got large
What is the
customers.
use case?
The use
Like to
case is
read
very simple,
checks?
right? No, so the use case right now, the use case being used is actually quite simple. The first use case is that RBI came back saying that banks should not be storing the Aadhaar number of a customer when they're doing KYC. Because Aadhaar number, like I said, Aadhaar number can become a financial transaction number, right? You could withdraw money from a bank account if you know your Aadhaar number and with the biometric data, right? But when you do a simple KYC and a customer starts giving you a copy of the Aadhaar card, what you store in your account has to be a masked Aadhaar card, which means the number has to be masked, right?
Okay.
Now, what banks were doing in the old days was they were physically taking a printout, crashing out the and putting it out. And there are
Okay.
billions of documents where the banks are still sitting on the Aadhaar card. All of that has to be recut. RBI keeps coming up with newer deadlines by when that needs to be done. So this is a one simple tool that this one simple utility that this thing does is it scans, identifies where all the Aadhaar number is, and is able to mask it completely and store it automatically. So what was
Hmm.
the manual process, right, is now into microseconds you are able to complete that process. I'm just
Got
giving
it.
one use case. There are at
Yeah,
least
yeah,
20
yeah.
use cases we have, because the other use case that we are building right now is, or it's already built actually. We've already got a customer on that. Is moment you are able to capture data, right, and that data can be put into a legible format, then you can play around with the data and you can do analysis on the data, right? So what capabilities do you have? What is your capability of reading that data, and what are the various kinds of factors you are taking to read that data properly is what differentiates between one OCR technology and the other, right? And when we looked at our OCR technology, and we looked at other players like Sciency, etc., that are also having their own OCR technologies, and we used things like smudged Aadhaar cards and other documentation, we found that our reading success rate was significantly higher, which is the
Mm,
reason why some of the large insurance companies, I can't give you names because I don't have authority from the customers to give names, but some of the large insurance companies are actually using our tech today. So it's
for
just been
KYC,
six, yeah. For well, they're using it for KYC, they're using it for
reading the
For Nash,
claims.
for
Okay.
Nash, right? For example,
Okay.
when you do
Mm,
a payment claim, right? There's physical Nashes that are given where a customer just signs up all of that, right? You need to scan the Nash and then convert that into an authenticatable document that will eventually fly into a Nash credit or a debit that needs to be done. We've
mm,
provided the entire automation of that whole process as well. So using OCR as your basic tech, right?
mm,
What can you do with that data that is being captured is the way we think about life,
mm. Okay. And
right?
that's 100% subsidiary, or it's a part of
That's
Niyogin
100%
only.
subsidy. That's 100%
Okay.
subsidy
Okay.
of
Okay.
Niyogin,
Okay.
of Niyogin.
Right. Yeah. And that would be early days, right, in terms of revenue.
Yeah, it's been just less than 6 months. Yeah, it's been, but
Mm.
less than 6 months. है, एक दो करोड़ का revenue तो फिर भी कर ही लेंगे. We will do. I think in the next
Okay.
3 years we will see significant jump in that.
Mm,
And the beauty is why I bought that toolkit, quite honestly, was because I also got 9 really smart engineers along with that business. Right, these are
It
all
was
AI trained machine learning. So one could think it's an acqui hire,
acqui-hire.
right? But then
Right.
we need to do something with those engineers, right? Which is why
Mm,
now we've got a roadmap of creating multiple. I'll give you another example of a product we are creating, right? Today, the market is dominated, the bank account analyzer market is dominated by Perfios. Perfios is a company in India that basically created this platform where when you want to do the analysis of a bank, you want to give a loan to a customer.
Okay. To give a loan, you have to read the bank statement,
Yeah, you
that
have to
how
read
much
the
money
bank.
comes in.
Yeah, how much money, how many credits have come, how many debits have come, what are the
Right.
outlier debits, outlier credits, and all of that, right? So
Mm.
Perfios has that system. We use it in Niyogin. We use Perfios,
Mm.
right? But once I have this high quality OCR capability, I can just build my own Perfios solution. I
But
can
this
build
is
a.
I mean, it's a dying market, right? With account aggregator. Uh, th-
Yeah, I think it's not a dying market. It's a market that will reformat itself because the account aggregators will need to have the firstly you will give permission to the entity, to the account aggregator, to share your financials with the lender, but the account aggregator will again give an account statement to you, right?
oh, they
What are you giving the
okay.
authority to the account
But
aggregator? You are
but
basically.
that will be like you don't need OCR for that account statement, right?
No, you don't,
To
because
read
it is
that,
a digital account statement, right? So
right?
you
It's a
can
digital
easily pull
statement,
out
right?
data and all of that, right? So
Then
we'll
it's more
see.
of
That's
like
why. So
doing analytics on it and coming
yeah,
up with
yeah,
a.
yeah. You can do that, but I think my view is
But
that
globally, this would still have a use case, right? Because
100%, 100%. See, the beauty about tech solutions is that why are you limiting yourself to India,
mm,
right? You could do, of course, globally you need to be worried about vernacular. You need to make sure that language, suppose your Chinese language for us to be able to understand may be tough, but
mm.
English is still a language in most countries that we want to operate in, right? You go to the Middle East, you'll still have English account statements and all coming in, right? So I think our view is that build
One
the tech stack. Sorry.
I would understand this account aggregator framework a bit better. I first heard about it like more than 2 years back with
Right,
I was
right,
interviewing the founder of a TSP, which
right.
was building in this space. Is it mainstream yet, or is it
No,
still like it's
no, it's
coming?
not.
It's coming.
It's
Because I've
coming.
been
It's coming.
hearing it's coming for last 2 years that
It's still
account
coming.
aggregator is coming.
It's
Oh,
still
it's still
coming.
coming.
See,
Okay.
the idea, I think the
What is
proposition
the
is
reason
fantastic.
for that? Like,
I
yeah,
think
because the idea is fantastic, right?
yeah.
So.
See, the idea is fantastic. The customer consent is very important in an account aggregator solution, right? And in the account aggregator has to be integrated with all the banks, because I may have an account statement with different banks. I think the big problem with the account aggregator is that the cooperative banks are not integrated. There are 800 cooperative banks, right? So the mainstream banks, which are 40 banks, easy to integrate with them, right? But when you start talking about rural India, you start talking about the tier two, tier three, tier four cities. The cooperative banks do play a material role, right? And the that part integration has account the. I mean, think about it. The cooperative banks are not even integrated with MPCI today. So
Mm,
until those integrations start getting done, right? Unless an RBI and MPCI had announced that they're going to get 800 cooperative banks integrated, this was like a year and a half ago. अभी तक हुआ नहीं है,
mm,
right? I've not seen that happen, right? So I think some of those challenges have to be sorted before this becomes a ubiquitous product. So when I say it's coming, it's not that it's operational today, right? It's operational up to a certain point. But the point when I'm looking at a customer, right? If I'm going to give a loan to a customer A, which is a corporate customer, he has five account statements, five accounts that he works with, right? Three of them are material, SBI, BOB, Canada, or SBI, BOB, Axis, and then two are cooperative accounts. If the account aggregator just gives me data for three, it's not good enough. I have to still go back to the other two. I have to go back to the customer again. I have to collect the data again from the customer. So then it defeats the full purpose, right? I'm not getting the full experience of this.
Right.
So ho jayega. Like I said, it's coming. It will happen. This is one. I'm just giving you one data point. Um,
And who is building the pipes? Who is connecting these? Who's taking the effort of putting these small cooperative banks onto account aggregator?
So I think this is again a MPCI type project, which is being
Okay.
done through a centralized entity because no individual TSP can do this,
Yeah.
right? So it has to be a centralized infrastructure that needs to be created. So that's why I
Okay.
said, "Ho jayega." It'll happen,
Hmm.
right? There are so many other infrastructure projects, right? There's ONDC that is there. There's Oaken, which is there. There are so many other things that are there. But the problem with all of them is that we have one huge successful proposition, which is UPI, and then everyone else pales in comparison when you start looking at the success of UPI, right? The problem is everyone's expectation is that each of these should be as successful as UPI,
Next UPI.
right? So I think थोड़ा सा वो एक expectation का mismatch है यहाँ पे life में, right? And
Right.
all of them are
Okay.
working. See, it's not that all these projects are in some sense going to go live. They are going to make life simple. They will
Hmm.
at least address some parts of the problem if they don't address the entire problem, right?
Hmm.
But India is such a complex market, right? Even UPI, like I told you, right? UPI has oodles of transactions that we do. We can talk about the large number of transactions we do, but if we talk about rural India, you'll find that the number of transactions are not that significant,
Hmm.
right? So it's again UPI solved part of the problem. It's not solved the entire problem.
Right, right. Fascinating. Okay, so coming back to Niyogin,
Yeah,
we left that story at you joined during
yeah.
the
So
COVID
what we
period,
did,
and you
yeah.
shut
So
that,
what we did,
you
so
shut
so
down the
first we
lending
shut down
business.
lending. First we
Yeah,
shut down lending, right?
yeah.
Then we did two things. We said, listen, we have the CA network, right? And the CA network is still throwing up transactions because that network is now connected with us, all of that. Uh, we can't not look at those transactions. If we are not doing those transactions, let's create a distribution business. So we then converted the entire CA network into a distribution business. We went and tied up with more than 15, 20 other institutions like your Bajaj Capital, L&T Finance, Poonawalla Finance, give or take, Mahindra Finance, IDFC First Bank, whatever, 15, 20, almost 27 institutions. And we then started channeling those transactions to each of those institutions initially manually. Today, we've got a digital solution we've created called NeoBlue, where a CA can get onto that platform, and through that platform, he gets to figure out whether this loan will pass muster or not. He just puts in basic data, and we tell him there and then कि ये loan होगा कि नहीं होगा. And as a second part of the engine, what we've done now is we have input the credit policies of all our partner institutions. We are also able to tell the CA this loan will get done, and the highest probability of this loan getting done is with Bajaj or with Niyogin or with L&T, right? So it's a rule engine which we have based using the AI tech team that we acquired. We have created that rule engine basis there, and that rule engine is a machine learning engine, which means as we do more and more transactions, it will be able to guesstimate more accurately which is the right institution that can get this transaction done, giving a higher success rate to the CA for that institution to be done. So we created that part as a distribution business. Neogin balance sheet is also one entity which could be fed through that institution if the Neogin is the right institution to be able to do that loan, right? And what that engine also does is also optimizes for commission, which means different institutions have different commission arrangements with us. It optimizes. If more than three institutions are saying that they can do this loan because we think they will do the loan, then it'll optimize and say where is it that you get maximum commission, because we should give the loan to that institution, right? And therefore, so that engagement with the CA as a distribution angle became pretty good. Then we came to a
Your
balance
your
sheet and we said, okay, we are an
your
NBFC.
commission, your commission in that is what percentage of the loan
Typically,
amount?
it's 3%, 3.5%.
Okay, and there is no risk that you're taking in that. It's
No,
just
there is no
the
risk.
moment
No, there is no
the
risk.
loan is disbursed, you get the commission. That's
We
it.
get the commission, and if the loan defaults, it's the lender's problem. It's not, because we are not appraising the risk,
Right.
right?
You're just a
End of the day,
marketplace
we are just a
connecting
marketplace.
them.
We are
Got it.
creating the space for you. We are giving you access. So I'm solving your origination problem.
Hmm.
Remember, I told you in the beginning, one of the big problems was that people spend lots of money on origination, right? I'm giving you the origination capability, right? I'm getting that done for you. You're getting those loans, and you're getting those loans in a pretty baked form, because for me to decide where this loan will get better done, I've already pulled out the CIBIL score, I've already done the bank account analysis, I've done everything. So I'm giving you a fully baked file. I'm not
Hmm.
giving you just a name that, okay, there's Akshay who's sitting in this corner, please go give him a loan to him. Then you have to go
Hmm.
pick up all the information. I'm giving you all data. I'm giving you Akshay's account statement, I'm giving you his KYC, I'm giving you his CIBIL score, I'm giving you extra information, his balance sheet if that's required, his P&L. Everything is being put in a way saying why you should do the loan, because one, two, three, it all stacks up.
Hmm.
Right?
And
So
what is
decision
the?
making,
Hmm.
sorry.
No, no. Please complete.
Yeah. So that was on the distribution side. And then we
And
said we have our
what is
own
the
balance
monthly
sheet.
revenue of that? Sorry, before you move
So
on.
I think, see, this business again is an evolving business. We do in the ballpark of about anywhere between 50 to 70 lakhs a month of revenue, right, on this business. But ये आराम से 2 3 4 करोड़ आराम से हो सकता है, right? It can actually get to that level, because
Hmm.
our Neo Blue solution is only about a couple of months old, right? Some of,
Hmm.
like I told
Hmm.
you, right, you have to think of us as a 3-year-old company. Don't think of us as a 10-year-old or a 7-year-old company. So a lot of
Yeah.
these propositions are first conceptualized, then we test them out, then we build the product, and now these, and all the products I've told you are live products. These are live,
Hmm.
running as we speak, right? And they will all potentially scale up.
Okay.
Then on the lending side, we figured out that how do we build the business, because if we keep going around trying to identify customers by ourselves, it'll take a lot of effort, time, and cost, and we may still not be the best at it because we may not get the best customers. So we said, let's create a partnership model where we will work with other people that have created ecosystems, right? So take the example of an entity like Khata Book, which is one of our big partners, right? Khata Book is has more than 10 million retail outlets that is using their software for their accounting services. So we tied up with Khata Book saying, you've got 10 million retailers, these people need money, right? Why don't we create a joint lending program where we will lend to them? You give us the data that you collect, we can use that data to better underwrite, you become the originating entity, right? We will lend to them, we you decide what price the loan should be given at, we need a hurdle rate, call it 19, 18, 19, 20%. That is what we want to make. Anything above that you can keep, and you also partake in the risk with us, because RBI allows you to partake in 5% risk with us. So you take 5% risk, I take 95% risk, but I do underwriting, I don't give the underwriting to you. You help me with the origination, you help me with the collections, because the customer is closest to you, because you are anyway giving your software to him, you have access to the customer, you have engagement with the customer. And so we said, let's create the partnership model where we are able to originate sensibly. I have effectively zero cost of origination out here, right? Because Khata Book is putting their people to originate the loan and so on and so forth. I do the underwriting, so I have some cost on the underwriting. On the collection side, the regular collection again happens automatically through a QR code solution that has been implemented in Khata Book's platform, right? Now that QR code has been given to them through Pine Labs, we could have also given the QR code, but notwithstanding, right? There is a solution where digitally the payments come to us, and the product is like a EDI product. It's a daily installment product. If I have 10,000 loans with Khata Book, I get 10,000 payments every day. All 10,000 payments are being applied to the loan every day. That is just one product for one customer, right? Now, if you are not a tech enabled company, you can't do this. How will you manage 10,000 payments coming every day? Who's going to pass those entries? You'll have an army of 10,000 people to do that. My operations team is 4 people, right? My technology team is 20 people. My sales team is 3 people, right? And we
Wow.
are doing this line of business with, and this is just one example of one customer. Why? Because technology enables us to be able to do that. So in the Khata Book ecosystem, it's a straight through processing system. We have kept the underwriting is all engine based, right? And there is no exception allowed. If the transaction fits in the rule book, it gets done. If it doesn't fit in, it doesn't get done. Because for a 1 lakh rupee loan, we can't be sitting and doing exceptions, right? I mean, that's just not my DNA. So they are originating, they put it on the system, it flows into our system. If everything works well, a loan document gets triggered to the customer digitally signs that, and the loan is disbursed automatically. Zero manual intervention. Zero manual
Yeah,
intervention. Right
that
now,
sounds like a
this,
really sweet deal for you.
yeah, no, it's a sweet
Like,
deal for both of us, right?
yeah.
It's a sweet deal for both of us,
I
because
mean,
we've
you
suddenly got.
like that 19% hurdle rate is pretty sweet, right? Like,
Yeah, yeah. I'm just
the-
giving you an example of. I'm not saying that's the number with them, but I'm saying that's the number that I would solve for, right?
got it.
Mota mota, between 17 to 20% is what I would solve for, depending on the partner, right? And we try and solve for that number, because we think for the unsecured business loan, and don't forget, I also have a 5% risk cover out here.
Yeah.
So
Yep.
beyond that, for the first 5% risk cover will go to the partner. After that, my loss will be high, right? And our
Yes, yes,
losses,
yes.
frankly, we've been doing this for more than a year and 3 months now. Losses are zero.
Wow.
Losses are zero, right?
Amazing.
And so it's
Amazing.
worked out quite well for us. Now one
Your
can argue
NPA
is
in
your
this business is zero. Wow.
yeah.
That's amazing.
On I'm just talking about the Khata book proposition, right?
Ah,
The losses would be about 1.5%, but that 1.5% will go to them first, right? Because 5% risk cover
yeah,
तो
yeah,
उनका
yeah.
है.
Right,
तो
right,
मेरा
right.
लॉस
Got it.
जीरो है. I'm not saying कि पोर्टफोलियो का
Ah,
लॉस जीरो है.
got
मेरा
it.
लॉस जीरो है.
Understood.
ठीक है.
Right, right, right.
And so
Amazing.
similarly with them, we've tied up with more than 10 such partnerships, right? Khata book was one example. There are 10 other partnerships. There is another NBFC called Capital Trust. There is an entity called Ninja Card. There's an entity called Karma Life. There's an entity called Fatak Pay. We've just tied up with other institutions that have created networks, right? And have some engagement with the client. I'm not tying up with institutions that are basically loan originators. Akshay could create a small company tomorrow, put 20 people in a call center, and they could just make phone calls and start originating loan. I have no interest in working with
Yeah,
you on that.
the DSA model basically.
Yeah,
Yeah.
that would be a DSA model. I am not working
Yeah.
on it. That I would still take from you, but I will take that for distribution. So if you are a DSA, you could work with me and I could give your loan, which you give to me, I could give it in the market and I could get it done. There also DSAs actually work with us primarily because if I aggregate DSAs, I get better economics from the final lender. So
So
if I work with
DSAs
one,
use that the blue. You use the name I forget. Blue
Neo Blue,
something that
Neo Blue, Neo
Neo
Blue,
Blue. Neo
Neo
Blue.
Blue,
So the DSAs use
NIYOBLE.
that. Okay.
Yes.
DSAs use that product.
That's right.
Okay.
That's our platform is DS. That's again
Okay.
proprietary platform that we've created, right?
Hmm.
So again, what I want to leave you with, Akshay, is that in every part of our ecosystem, we think technology first, right? And with every part, whether it is distribution, whether it is the NBFC, where one would very easily think old school lending क्या करना है, loan आएगा, application आएगा, 10 people are sitting out there, somebody will appraise it, ठप्पा लगाएगा, then it will go to the operations team, they will look at documentation and finally agree. How do you think tech to try and get this done, right? I think we have thought of tech everywhere. iServeU anyway is a deep tech company, so their technology is the way of life in any case, right? But even in the Niyogin mainship, we have tried to use this, and now what we're doing is the AI company we acquired, all the KYCs, etc., that we're doing are all using our own AI tech to be able to find a more efficient way and to have less rejects on people putting up a PAN card. You waste time. Yeah, it rejects. Then the system throws it up. You go back to the first line, right? So you have to look at system efficiency also. Do it right the first time, right? These are all big terms people use, but philosophically, that's exactly what we believe in, and therefore we are building each of these pieces slowly and steadily, right?
How
So,
much is your loan book through these partners?
see,
This Khata book kind.
loan book will be about 250 crores today,
Hmm.
right? It's not a very large loan book because the first 100 crore loan book though we brought down to zero completely, right? It's a new
Right.
book that we built over the last 2.5 years,
And
right?
average tenure. This is like short term loan, long term.
No, no, no. So see, average tenure of this loan book will be about 9 months,
Okay.
right? Because
Got it.
some of the partners that we're working with, we actually end up giving 3 year loans,
Okay.
right? With Khata book, I think the door to door tenure is I think 11 months. So average is about 6 months. With Khata book specifically, it's 6 months. Actually, it's a little
What
longer
do
than
you
six
mean
months.
door to door tenure? What
Door
is
to door
that?
means from the time I give you the loan to the time the loan gets fully paid.
Okay.
So I give you
Okay.
10 rupees. You're paying me some back every day, but door to
Hmm.
door means from on first day when the loan is full to the loan going to zero,
Hmm.
right? It's 9 months, right? But I'm getting paid every day, right? Some
Yeah.
EMI I'm getting paid every. So average tenor is defined as what is the average period that loan was outstanding on my books. So I think we're
Okay.
using different terms, but I'm just trying to tell you how the market uses
Huh.
these
Got
terms,
it. Got it.
right?
Got it.
So
Okay. Understood.
we are not doing extremely short term. I'm not doing a treadmill
Hmm.
business where I'm every month I'm redoing all my entire loan book. Every
Hmm.
month the loan book gets paid and I'm recreating the loan book. I think that's too much of a treadmill for us, right? और इतना इतना हमारा DNA नहीं है काम करने का. We want to work, but we want to make sure that not everyone is on a treadmill. But we also don't want to be at the far end of the spectrum because these are unsecured loans at the end of the day, right? Customers' positions change, right? They have some loss in business, they run away, they disappear, they shut their shops and all of that. So you don't want to also be in it for a really long term. So we found this right mix, right? And average ticket size is also in a Khata book construct. The average ticket size could be about a lakh, but overall, if I look at my full portfolio, average ticket size is about 2.5 lakh rupees, right? So you're
What
giving.
is your ambition in terms of the loan book size you want to hit?
See, I think we should be hitting next year. We've raised some equity, so in February we are going to get another 60 crores of equity, right? So that will come in, and today in the lending business we have close to about we will have about let's call it 200 crores of equity dedicated to the lending business, right? I think taking three times leverage should not be difficult on that space, right? So 800 crores, 200 plus 600 crores. I think next year we should solve for about 800 crore number is what I think, right? At 1000 crores, I will feel comfortable. At that point in time, I will start thinking, what do I do with the loan book? In the sense that don't forget, each loan that I'm doing is actually a priority sector loan because I'm giving money to an MSME. This is all counted as priority sector. Now, there are banks that are struggling to get priority sector assets and they need to meet priority sector requirements as per regulation every quarter end. So, once we've created an ecosystem of about 1000 crores book, we could we could potentially start selling it to people who need this, make some money on that, but keep building the book also, keep doing the loans, right? But so I think right now the thought process is let's just get to 1000 crores, then we'll talk about what is the best way. From 1000 do we go to 5000 crores? Is that the way to think about it? That is how a traditional NBFC would look at life,
Hmm.
right? Is that going to be our DNA? That will require us to raise more capital, take more leverage, so on and so forth. Or do we get to a stage where we get to a right size of, say, let's 1000 crores, and then we see how best to monetize this book, right?
Hmm.
Keep churning, keep selling down, keep creating new loans, right? Because we also get some fees when we do these loans. Keep the fees in your pocket. Then you sell down, you make some more fees. Keep increasing your revenue, right? That way, and build the book. So yeah, yes, I don't want to give you an answer, which is because I have not thought through it. Because the
Right.
problem is that if we think too much in the future, we lose sight of what is to be done today. So right now, the team is all singularly focused on getting to 1000 crore book size.
Hmm.
Right? When we get
I,
there, then we'll talk about what else we do next.
yeah. I love how much you think like an investment banker with everything. I mean, like looking at bips and everything, and looking at, okay, we have a loan book, but the goal is not loan book for the sake of loan book, but how do we
Correct.
monetize the loan book? And
Correct.
so I mean,
I mean,
that's
we have to be different, no? Because reality is that firstly, our business is a business of pennies. That's why the bips are important. Moment
yeah.
we lose sight of that, right? Every penny matters, and that is
Hmm.
exactly how we look at our expense base. We look at our revenue base, right? It's important for people to have, and all of these. I genuinely believe that culture always starts from the top, right?
Hmm.
Unless I speak the BIPS language, why would anyone else speak the BIPS language, right? So unless I care about every penny in the system, why would people care about the penny in the system, right? So that is important, and the strategic element, not everyone needs to know, because some strategic element are slightly long term. Like for example, the book thing, right? What do we do with the loan book? I think we'll worry about it when we get to that stage. Right now, we have to. The way I think about life is that businesses always need to have a 1 year, 3 year, and a 5 year strategy, and sometimes the 1 year strategy and the 5 year strategy may not even be in sync, because your thought process is that right now the 1 year strategy is that keep building the loan book. The 5 year strategy would be that not to build the loan book anymore, but to start churning the loan book. And one may turn back and say, but these are not, comparable strategies, these are reverse
Hmm.
strategies. But at that stage, what scale we are in, we'll take a call at that point in time. So some of these things are things in my head which I haven't really put on a piece of paper. But as I see, and the market is an evolving space, right? The one thing we learned in my experience is that the market is never wrong. If the market is doing something right, we need to be respectful and then try and see. Don't just brush us aside saying that I know better than the market and therefore we should do it, right? I'll give you an example right now, right? Today, uh, unsecured business loans are going through a certain slowdown in the market because there are entities that have taken some losses. The Indian economy is at tad slowing down, right, as we speak. And some of the smaller businesses are struggling, right? It is silly of us to keep thinking that there is a 30,000 crore market so we can keep growing the book without realizing what is the reality on the ground, right? So keeping your feet on the ground and the ear on the ground is super critical in this business, right? And especially for us, because think about it, right? In the lending business, we are a digital company. We don't have branches. If I had branches in, I'm originating a loan from 30 locations. I don't have branches in those 30 locations. How do I get to know what's going on in those markets, right? I have salespeople that are floating around meeting customers and CAs and all of that, right? But if we don't keep our feet on the ground, and if we don't keep our ear on the ground, right, we can completely get taken for a ride.
Hmm.
So
Amazing.
some of these are very basic principles of life, right, which have been
Hmm.
learned with I think some cost that might have been paid as we learn some of these lessons in
Yeah,
life, right?
yeah,
But if you don't learn from those lessons, then you'll repeat the same mistakes again.
yeah. What was the private credit book at KKR? Uh,
So private credit book, I think the way we would think about private credit in KKR was we would think at the amount of volume of businesses that we would do. We would do almost $1 billion every year. $1 billion
In
of
India?
disbursements in India we were doing every year,
Wow. Okay.
right? Which is
Massive.
not small, which is
Mm,
quite huge, right? And it was, some of it would come back because if your theory is right, a customer would not keep such expensive debt on your books, right? A customer
mm,
would, I'll give you an example, right? Metropolis, when Metropolis was a private company, we financed their, they had an investment from Volvo Pincus, and the founders wanted to buy back Volvo Pincus. We financed them with the money to buy back Volvo Pincus, and that loan was a long-term loan, right? But in 6 months they did a second equity deal where they sold the stake to Carlyle, and then they paid us back. Right, so the
okay.
transaction got done, which was a large transaction, but it lasted only 6 months, unfortunately. But it was the right thing to do because why would the founders of that company want to keep expensive debt on their books,
Mm. So,
right?
having seen that kind of scale, where you were managing a
Yeah,
$1 billion book to now you're talking of 1,000 crore book in a
yeah.
couple of years, like, does it seem like that you need to like chase still like that $1 billion book kind of a number, or what
No,
is
not on the
that?
lending side. See, we need to chase. I think the way life has changed is the book is irrelevant. We have to chase valuation. We have to
Okay.
create a business that gets valued at $1 billion, right? That is more relevant to us than to
How
just
will
go on
you
telling
how
the.
will you reach that number, a
I
billion
think,
dollar
I think,
valuation?
yeah, I think, which is the reason why I am not a believer of one trick ponies. I don't like businesses that only operate on single thing. Now, people will disagree with me on this because someone will say that when you have a one trick pony, you're like Arjun in the Mahabharata, where you're focused on one goal and you will keep doing that cut, right? I think Indian market and our regulator has also come with so many changes in the regulation as far as technology companies, fintech companies are concerned, right? I think we are better de-risked when we have multiple sort of horses running in the race, right? So lending is one horse in the race. iServeU is the second horse in the race, right? And iServeU itself has created multiple horses in the lane because it's got multiple product capabilities. So the way I think about life is we have multiple horses in the lane, right? Not every horse needs to finish the finishing line, right? But a few horses certainly do need to finish the finishing line, and that is where, as as we build each of these businesses, we also will get more clear on where we need to spend more of our time, where we are seeing better traction from customers, right? Where we are seeing better traction because of our positioning is unique, which is why if you look at both on the lending side and on iServeU, there has been significant new product development that we've been doing. You could argue that we are doing experiments. Every time a new product gets developed, that's an experiment we are doing. We've also killed products because we thought that these products we may have built, but they're koi fayda nahi hai. There's no point wasting time running after this product, right? We actually built, I must tell you this, we actually built a alternative to Shopify because we were dealing
Okay.
with so many MSMEs. We created something called a business builder, which is
Uh,
basically getting a small
like a
business to
dukan.
become online,
uh,
like Dukan, right? And then we figured that no one pays for this,
yeah.
right? And there is no way for us to monetize this, and it's just too much of heartburn for us, and we don't want to spend time doing this, and so we killed the product,
Mm,
right? And we figured out that there were too many other people who were doing this, who were bigger, better than us, and we were a distant, not even third, different 10th or 12th or 14th. It didn't make sense, right? We
right.
built it, we tried it, we gave it to some customers because when you have a in-house engineering team, you can do whatever building that you want to do, right? I have a very the beauty of working in fintechs is I'll tell you, being at the wrong, I'm the person that spoils the average age of our group, right? But the problem is these young guys keep coming up with so many
Yeah.
ideas. Everyone
Yeah.
comes back and they'll sit in the office and they'll talk about, listen, why don't we do this? And
Yeah.
I'm the last guy that puts people down. I tell them, boss, chalo, let's try and do something. Let's try and do
Yeah.
something new. Let's
Right.
figure out if this thing will work, right? So it also sparks a culture of innovation. It sparks a culture. People feel that the organization supports new idea generation. Not
Mm,
every new idea will see the light of day,
mm,
right? Which is how it's going to be, right? But I think people have to feel empowered to come and speak up and to tell that, okay, this is what I think we should build, this is how we should change the product, right? The rule engine we have created for Neo Blue, which actually has all the 27 partners there, platform actually came from one of our team members. He says, why would we not build something like this?
mm.
And he was part of our AI team. He says it can just make the whole process so much more efficient than us sitting and doing it manually. And I said, yeah, sounds fantastic. How soon can we do it? And we went live in less than a month.
Wow.
on that proposition. So I think the idea is that create the culture, and don't think about book size. Book size is irrelevant here, in my view.
But will lending an iServeU get you to $1 billion valuation?
I think the right answer question should be, when will lending and ISRU get you to $1 billion valuation?
Okay.
If and when में थोड़ा फर्क है, right?
Okay. Okay.
So
Fair.
I think the valuation is a function of how successfully we can grow these businesses, right? And 3 years ago, fintechs were being valued at some ridiculous valuation, right? You look at M2P today. M2P is valued at $900 million at last valuation. I'll give you some numbers which will give you some color, right? M2P financials, you can pull them out from MCA website. We are probably in IServeU, we are probably 1 year behind M2P in terms of
Okay.
numbers,
Hmm.
right? Now, product capabilities are different, valuations will be different, right? We don't get any of that valuation because we are in the public domain. We are a listed company as against being an unlisted company. I think
Right.
our valuation would have been very different if we were in an unlisted. Doesn't matter.
True.
We'll still
True.
fight the
True.
battle
True.
in the listed space because listing also has significant positives for me, for my employees. When I give stock options, they're able to monetize some of that, which a lot of the other unlisted companies, you just keep employees, they're sitting there for 7, 8, 10 years without seeing any liquidity,
What's
right?
your
We
market
think
cap right now?
we're about 700, 7, 800 crore market cap here.
And
So it's a small company.
how's the share price moved over the last 3 years?
So share price has gone to as low as 30 rupees to as high as 110 rupees. Today it is in the ballpark of 70, 75 rupees,
Okay.
right? In that ballpark, right?
W-
And
Why did that
we
110 come down to 70? I mean, you are arguably in a better position today, right? Than,
Yeah.
or was it just market sentiment that drove it to 110? And
No, market sentiment here. We've also had some when we do experiments, right? It's not that every experiment is successful. Sometimes you do land up hitting some pitfalls, right? We had a small receivable problem in iServeU last year before last, right? And then we had to clear it out. So we took a little bit of we said, let's just clear out these were old receivables because like I explained to you, we moved the iServeU strategy from a retail focused entity to an enterprise focused entity. So some of
okay.
our retail receivables that would have remained pending, those would not be collected because of various reasons, right? And therefore we just wrote off some of that stuff, right? So you'll have to keep doing a cleanup, but we've also invested equity. Like I told you, we put in the RPS of 50 crores into that company. I'm talking about a few crores here and there. I'm not talking about large write-offs, right?
Right.
So I think some of it the market doesn't like. Market expects that growth should keep coming continuously. Then we also got hit by iServeU is not necessarily a regulated entity, right? It's not, it doesn't have a PPI license or a PAPG license, right? And we were becoming quite big in the UPI space where we were powering customers to accept UPI as a payment. I could give you, if you had an online portal like what Razorpay does, right? Razorpay enables you to accept UPI. We have the same capability, but that
Okay.
capability, which was becoming a good product, suddenly got hit because RBI came with a circular saying that only people who have a PAPG license should be doing this. They didn't say
Yeah.
that directly, but the banks interpreted it to say that you need to have a PAPG for us to do the settlement for you on the UPI side. So
Mm,
we saw a little bit of a road. So थोड़ा ऊपर नीचे हुआ है on some of these things, but nothing has materially changed the path that we have taken. Right? These are tweaks
mm,
that will come
mm.
in.
Right.
Right. So I think the fact that the business still stormed ahead, continued to grow. We acquired the company as a 20-25 crore company. Today, in 3 years, 4 years, in 2020 we acquired the company. In 4 years, that company will become a 200 crore company plus company. I think that
Mm,
company very easily can go to 500-600 crores in the next few years. and
right.
and and the point is, it doesn't matter, the top line is a irrelevant number to me. What will happen is that the EBITDA generation of that business from FY26 onwards will be material, and that I
Mm,
think will put the game in an interesting way. If you also overlay the fact that if our technology starts getting accepted at a global level, not only at an India level, that puts a different perspective on how that company needs to get valued. In the
yeah.
meantime, the lending business, if it can grow to become 1,000 crore book, which I think there's no reason why we should not, and if we have got the right ecosystem of operating leverage. So here's my take, right? My big statement that I make to my employees and to our investors is that we need to be in the business of operating leverage, right? When you
What does
build
that
these
mean?
business,
Operating
operating leverage
leverage.
basically means that my revenues can scale at a significantly higher pace than my expense. All
Okay.
the expense I need to do is already factored in. I don't need
Mm,
to increase my talent pool or number of people. It's a different matter. If I open up a new market, I open Dubai, I need to set up an office there, that will add a separate expense. So keep that aside. But for my
mm.
core business, all I need to
Every
do right now
additional
is
dollar of revenue should not cost you. more, basically.
Yeah, basically, additional dollar of revenue should flow straight into my bottom line,
Right. Okay.
right? That is operating leverage. And fintechs, you should be investing in fintechs when you see operating leverage coming in. If a business does not have operating leverage, if I need to, and there are some fintechs, I don't want to get into names, you will hear about fintechs, for every $1 of revenue, they have $1.2 of expense.
Hmm.
Now that's a
Right.
disastrous model for me, because you can keep scaling up. So you will go from 100 crores to 500 crores. But if my expense is going to grow from 120 crores to 600 crores, it's a meaningless business.
Hmm. Right.
When does a business's operating leverage come into play is material. For Niyogin, the operating leverage is here and now.
Hmm.
That's the bottom line, right? So FY26, we will have this conversation again, Akshay. I hope you keep tracking us. In
Hmm.
FY26, when we have a conversation again, I should be able to demonstrate operating leverage to you.
Hmm.
If I have not, then we have failed, or we have got delayed. I wouldn't say we have failed. I would say
Hmm.
we've got delayed. I
Right.
actually genuinely am super convinced about the success opportunity that we have in front of us. It's a
Hmm.
question of how long will it take for us to get there. Will we get there in a year or 2 years? I don't know. But the point is that if the operating leverage starts getting demonstrated, automatically the market will take notice, automatically the valuations will change, automatically people will start valuing us very differently.
Hmm.
And
You're
I
already
don't think
EBITDA
they should
positive.
value us differently till we show the operating leverage.
Yeah, yeah, that's true. Fair point. You're already EBITDA positive.
We are EBITDA break even this last quarter. We were EBITDA break even.
Okay, okay, okay. Amazing, amazing. Thank you so much, Tashwinder. This was a fascinating chat, and I truly appreciate how deeply you went into everything I was curious to learn about.
Thank you, Akshay. This has been good. I think also I'm glad we've almost kept to our time of 2 hours, right? Which was good. But I would urge you to keep a track of us,
Yeah.
and then we should probably circle back in about a year,
Hmm.
on how things have played out. Yeah. Thank you so much for your time.